Okay, good morning, everybody, and welcome to this session on geopolitical risk in the financial sector. My name is Zuzana Fungaceva. I'm from Bank of Finland, and I'm very happy to chair this session. We will have two wonderful papers, and the first one will be presented by Emile Sanders from Ghent University, and it's on geopolitical risk, cost of equity, and lending. And both of these cases basically have the geopolitical risk caused by the war in Ukraine. So I will now give the floor to Emile. We have 25 minutes for the presentation.
Okay, thank you. First of all, thank you to the organizers for allowing me to present this paper. Very happy to be here. So this project is titled Geopolitical Risk, Cost of Equity and Lending, Evidence from the Ukrainian War. And it's joint work with my co-author Rudy van der Vennet, who's like me also from Ghent University. We're still working a lot on this paper, so any feedback, comments are very, very welcome. So, okay. So first, a little bit of context. So as you're all aware, February 2022, Russia invaded Ukraine. And this was a major escalation in a conflict between these two countries that had already been ongoing for a little bit. And one of the consequences of this was that geopolitical risk emerged as a major source of uncertainty for the financial sector. So as researchers in banking, we wanted to understand better how does geopolitical risk impact the banks and their lending behavior. So that's exactly the question we want to tackle in this paper. How does this shock, the Russian invasion of Ukraine, impact the banks and their lending behavior? And we believe that our contribution is twofold. So on the one hand, we estimate the short and medium-term impact of a geopolitical risk shock on bank lending behavior. And we also integrate the role of banks' cost of equity and changes in banks' cost of equity. Now, why does cost of equity matter? Well, to do lending, banks are required to hold equity, to hold capital. And equity is an important building block of capital. So if the cost of equity changes, this could have implications for the overall funding costs of banks, which could in turn, in theory at least, affect lending. So yeah, of course, geopolitical risk is very topical right now. So there is the seminal paper of Caldara and Iacovello, who show, among other findings, that geopolitical risk is positively associated with financial instability. Also, for the banks themselves, there is research, for example, Vanedal, who show that it is positively associated with bank risk. Now, of course, in this paper, we will look into credit supply. There we're also not the first, so geopolitical risk is negatively associated with credit supply. For example, Nietman and Shen, they show that US banks, when they face geopolitical risk, they tend to reduce cross-border lending. Also Pradhan et al., they show this, but you can see these papers are all very, very recent. Then specifically for the Russia-Ukraine conflict, there's research that shows that it had a negative impact on stock market valuations, also for the banks themselves. Then there's also Dickelman, for example, who show that besides these negative stock market valuations, also the CDS spreads of these banks increase. Also, Dalducas et al., they find the same thing. So banks' borrowing costs increase as well as a drop in their share prices. However, we will focus on the cost of equity because we believe it's a better reflection of the cost of equity for the banks. So that's why we link it to lending. There's also already some research. For example, Kovner and Van Tassel, they show that a higher cost of equity generally corresponds with tighter credit supply. However, they focus on US banks, and they typically employ a longer time frame, so they don't look into sudden, abrupt shocks in cost of equity, which is the scope of our paper. So this is where our contribution comes in. So based on the literature, apologies for all the text on the slides, we draw the following hypothesis. So the first one is on the impact of cost of equity. So we hypothesize that banks that have direct exposure to this conflict experience an increase in this cost of equity, and we will measure the cost of equity based on their corporate lending portfolios. And then if we do a quick preview on the results, we exactly find that this is the case. So the cost of equity of these banks increases when they face a shock in geopolitical risk. Then the second hypothesis is on their lending behavior. So we hypothesize that the banks that have exposure to the conflict prior to the war, that they decreased lending. And again, we are able to find evidence for this hypothesis. So the exposed banks cut their credit supply after the start of the war. Then the third hypothesis kind of links hypothesis 1 and hypothesis 2. So we hypothesize that capital structure influences banks' post-shock lending behavior, and that a higher cost of equity or a larger increase in cost of equity will be associated with a more negative credit supply. In this part of the paper, we will also focus on banks' capital buffers. So bank policymakers typically focus on capital because it's shown in the literature that banks with larger capital buffers are better able to maintain credit during tough times. That's why we integrate the hypothesis that banks with larger capital buffers are less affected by the shock, at least in terms of credit supply. If we then jump to the results, that's also what we find. So these capital buffers are important because they mitigate the credit rationing effect, but we cannot link the changes in cost of equity to the credit supply of the banks. Okay, so the paper is structured in two big parts. The first part focuses on the cost of equity of these banks. So we have a sample of 68 listed European banks. We obtain stock market data from LSEG, and we also look at analyst expectations. And our methodology is a difference in difference framework. So we exploit the invasion, so the start of the Russia-Ukraine war, as a quasi-natural experiment in a difference in difference specification. Our dependent variable is the cost of equity, which is the average of estimates of 3 variations of a traditional DCF discounted cash flow model. So in these types of models, the cost of equity basically serves as the discount rate over which future profits are discounted to the current share price, and hence it's a reflection of the return that shareholders want for investing in a bank. So these models each have different specifications and variations. So some use measures of free cash flow to equity, but all use analyst expectations of earnings per share. And that's also why we only can include listed European banks. So this is one class of models to estimate the cost of equity. What's also often done in the literature is focusing on factor models, such as CAPM and FAMA in French. But these typically focus on kind of backward-looking information, which is perhaps not very ideal to detect sudden changes in cost of equity, which is the setup of this paper. But we are able to show that our results are robust to alternative measures of cost of equity. And then we are mainly interested in the coefficient on the interaction term between a treated and a post-dummy. So the post-dummy will be 1 for every observation after the start of the invasion. And we will derive treatment based on the outstanding stock of syndicated loans. So if a bank has, prior to the start of the invasion, so in the last quarter of 2021, outstanding loans to Russia-based borrowers in the syndicated loan markets, the bank is considered as treated. Otherwise, we will place the bank in the control group. And then based on the first hypothesis, we'd expect beta 1 to be significantly positive, indicating that the invasion resulted in an increase in the cost of equity of these exposed banks. Then we also do some robustness, but I'll come back to that later. So if you then do a quick preview of the results, we see that there is a sharp increase in the cost of equity for all banks, actually. So whereas the cost of equity hovered at around 11% before the start of the invasion, that immediately shoots up to about 15-ish% for the banks, for the treated banks, so those exposed banks. And this is more compared to the banks in the control group, so the banks without exposure to Russia. And we also see that this difference seems to persist in the weeks following the geopolitical risk shock. So this is basically 8 weeks before and 8 weeks after the start of the invasion, which is marked by the dotted black line. Then if we move to the results of the difference in difference specification, we are basically able to confirm what we saw on the graph. So there's a significant positive impact on the cost of equity of the treated banks coefficient is positive and significant on the 5% significant level, indicating that if you are, as a bank, exposed to the conflict through your corporate lending portfolio, your cost of equity increases. Now, of course, there could always be the issue that these banks are a priori to the conflict different in terms of characteristics, and therefore we do some matching as well. So we employ a one-to-one nearest neighbor matching algorithm based on several key fundamentals such as profitability, size, etc. So that reduces the sample a bit, but we are able to confirm our findings in the setup. The coefficient of the interaction term is even a bit larger in magnitude. So there's really this positive increasing impact on the cost of equity if a bank has exposure to the conflict. We also do some extensions and some robustness. So we also look into systemic risk. So we basically repeat the baseline analysis, but we swap out the cost of equity for measures of systemic risk. So we look at marginal expected shortfall, we look at S-risk and delta covar, and we find that there's a significant impact on the first two indicators, indicating that the exposure of banks to systemic risk increases following the invasion. But there's no real impact on the contribution of banks to systemic risk. This is quite interesting because it tells us a bit more about why this cost of equity increases, because it seems that financial markets perceive these banks as being a bit more risky, more exposed, if they are exposed to the conflict. Then also we do some robustness checks, so we look at alternative samples, we adjust the window, and so in the baseline we only look into exposure in Russia, but then we relax the scope a bit of the exposure measures, so we also look at the bank's syndicated loan exposure in Russia, Belarus, and Ukraine, and also the neighboring countries, so also Slovakia, I believe. But these results hold up quite nicely, and of course, because it's div and div, we check for parallel trends, but we are also able to satisfy that. So overall, these results seem quite robust and indicate that banks' cost of equity increases, which of course leads to the question, is there an impact in lending as well? And this is the second part of the paper. So here we use syndicated loans, which we obtain via DealScan, and we look at new originations only of term loans and credit lines to non-financial companies for a window corresponding of 1 year before and 1 year after the start of the invasion. So February 21 to 23, which is a window of 2 years. As for the bank data, via S&P Capital IQ and Refinitiv. And the methodology is actually very similar to what we did before. So we exploit the start of the invasion as a quasi-natural experiment, as an unexpected shock in geopolitical risk using a div and div framework. Of course, now we won't look at the cost of equity, but the dependent variable is the natural logarithm of the lending amounts. And again, we are mainly interested in the interaction term between a treatment and a post indicator. Post will be one for each loan that is granted after the start of the war, and the treatment, again, based on the outstanding stock of syndicated loans in the final quarter of 21, so before the start of the invasion. So if you have exposure to Russian borrowers, which is the setup of the baseline, the bank is treated, otherwise the bank is in the control group. Based on our second hypothesis, we would expect a significant negative coefficient, indicating that these exposed banks reduce lending, in terms of volumes at least. Then we also add some bank level control variables and some fixed effects. We include bank level fixed effects. We also do industry, country, quarter fixed effects to control for credit demand. And we also add some fixed effects based on loan characteristics. In this setup, we only look at loans that are issued by lead arrangers. However, the amount of leads per loan can differ. We want to avoid that loans with more leads are overrepresented in the dataset, and therefore we do a weighted least squares based on the inverse of the number of leads as weights. We add two big extensions to the baseline, so we will also incorporate cost of equity into the analysis. So we add, depending on specification, the level in cost of equity prior to the invasion and the change in cost of equity around certain windows around the start of the invasion, both in a triple interaction, but also in a kind of horse race setup. So adding a different, an alternative interaction with a separate post indicator. And then we will also do some sample splits, triple interactions to further investigate whether the impact differs for different types of loans. And we also look into relationship lending. So these are the results. So what we basically find here is that there's a significant negative impact on lending for banks with exposure after the start of the invasion. So the difference between the first and the second column is that we include the control variables in the second column. But these coefficients are highly significant and indicate that the size of a loan that's given by a treated bank after the start of the war, so by an exposed bank, is between 11 to 13.9% smaller compared to a loan that's issued by a bank in the control group. So there's really a negative impact on the volumes of the lending. Then in columns 3 and 4, we also look into loan pricing. So we look at the all-in spread drawn, which is basically a measure of the interest rate that that borrowers need to pay, but including all the fees, etc. There we basically find in the third column that the spread seems to increase as well. So there's also a pricing effect, but the impact vanishes when we include control variables, bank-level control variables, which is the setup of the fourth column. We also need to be a bit careful there because we lose a lot of observations. The spreads are not covered that well. So what we should remember here is the negative impact in terms of loan volumes, but we cannot really say something about pricing here. So here we further investigate the determinants of the credit supply impact. So in the first column, we just repeat the baseline. But then in the second column, we add a triple interaction based on banks' MDA buffer. Now, MDA stands for maximum distributable amount. And it's basically a measure of the headroom that banks have above regulatory requirements, which of course can be different for each type of banks. The problem is that the sample is a bit limited because we don't have this data. We need to reconstruct it. We don't have it for every bank. But what we basically find here is that capital really matters. So the coefficient on this triple interaction is significantly positive. And this indicates that banks with more capital headroom are less affected by the shock in terms of credit supply. So they reduce their lending less. So capital really matters from a policy perspective. And then in columns 3 to 6, so we add the variations of the cost of equity measures, but there is no clear pattern in these results, whereas the overall treatment effect remains quite dominant. So unfortunately, we cannot confirm our third hypothesis in that there's a relationship between the cost of equity, or rather the cost of equity is a driver of credit supply. It's mainly the overall treatment effect that remains dominant in this setup. Here we do sample splits to further investigate heterogeneity at the loan level. So in column 1, we only include term loans into the analysis, and there we find no significant impact. Then in the second column, we only include credit lines, and we find that the impact is mostly driven by these credit lines. This makes sense as credit lines are typically a little bit more risky for banks, and it also aligns quite well with literature on, for example, the pandemic that showed that in these uncertain times, banks mainly adjusted credit supply via credit lines. Then in columns 3 and 4, we look at relationship lending. So our definition of a relationship loan is the loan given by a bank to a firm at a moment where the bank already has a non-matured loan to that specific firm. And we find if a bank has a previous relationship with a firm, there is no significant impact in terms of lending. But the significant negative impact is only for new borrowers. Again, this makes sense. Banks have less information about these borrowers. They don't know them very well. So this type of lending is typically a bit more risky. So overall, these results suggest that it's a general risk aversion effect that plays here and that drives our results. Of course, we do some robustness, so we look at alternative samples, so only euro area banks. We adjust the window, so shorten the window. We also adjust our treatment definition to not only look into Russia as in the baseline, but also include that exposure to different countries. so to Russia, Belarus, and Ukraine, and also the neighboring countries, but overall the results seem to be quite robust. We also check for parallel trends, but we can quite, yeah, the assumption is quite satisfying. So to conclude, so we have two main conclusions. So on the one hand, the cost of equity increases when banks face a sudden, abrupt increase in geopolitical risk. In this case, the start of the Russia-Ukraine war. So we do this by, we show that banks with previous lending exposure to borrowers that are headquartered in the conflict area experience an increase in their cost of equity. We cannot link it to lending. We do find that a geopolitical risk shock, the start of the invasion, is associated with a decreased credit supply for the exposed banks, and that this impact mainly reflects the volumes, whereas we cannot really say something about pricing. But we find no evidence of cost of equity acting as a driver of this credit supply. What we do find is that capital matters. So banks with larger capital buffers are better able to maintain credit. So from a policy perspective, for policymakers, capital buffers are really important. The further analysis, we do suggest that it's overall risk aversion that plays. So banks typically reduce loans that are more risky for them, which is lending to new borrowers, and also credit lines as opposed to term loans. So based on this, we can draw important policy implications. So on the one hand, the findings can be a bit worrying because of two reasons. So on the one hand, there's a reduction in credit supply. What we do not do in this paper is look into outcomes for the real economy, but I mean, it's likely not to be good for the economy if credit is reduced. This likely reflects badly on firm outcomes such as investment, for example. And also, even though we cannot link the increasing cost of equity to anything that happens in terms of lending behavior, this could be bad in the long term, as higher cost of equity may worsen the capacity of banks to raise new equity, which could then in result have a negative impact on lending. So based on this, we can really conclude that geopolitical risk should be a relevant concern for policymakers. Thank you, and looking forward to the discussion.
Thank you very much. Thank you. And the discussant for this paper is Ursula Vogel from Deutsche Bundesbank. So you have 10 minutes.
Thank you very much. First of all, I want to thank for the invitation to discuss this very interesting paper here at this conference. And of course, as I'm affiliated with the Bundesbank, the usual disclaimer applies. So the paper deals with the question how geopolitical risk affects banks and also banks' lending. And as a geopolitical risk, or the geopolitical shock that is looked at here, is the invasion of Russia in Ukraine in February 2022. The effectiveness of banks is captured by the bank's cost of equity and also by different measures of systemic risk. Information on banks' lending is taken from the DealScan database with information on quantities of lending as well as prices in the version that I had for the conference. The sample consists of 68 listed European banks. And the empirical approach is a standard diff-and-diff setting with loan exposure to borrowers located in Russia as the treatment. The results show that that banks with this loan exposure to borrowers located in Russia prior to the war, that these banks are perceived as relatively, after the war, are perceived as relatively more risky by the markets. And at the same time, but independent from that, the relative lending of these banks decreases more, while the pricing remains largely unaffected. And the lending decreases more for new borrowers, as well as for credit lines rather than for immediately granted loans. And also, the lending decreases relatively more for banks with less capital headroom. So overall, I find this is a very relevant and topical question, particularly against the background of the increasing geopolitical tension that we saw over the last years and the increasing frequency of geopolitical shocks. And most importantly, it adds at shedding light into the macro financial dynamics as a consequence of geopolitical risk. So I have two main comments on this paper. One is related to the shock, how it is captured. The other one is related to the landing. So, of course, the invasion of Russia in Ukraine is a major geopolitical event, geopolitical shock, and it is captured in this paper with a dummy variable, marking those banks that have syndicated loan exposure to borrowers located in Russia prior to the war. So the relevant feature for this measure is the geographic location of the borrower rather than the nationality. I'm not sure if this was changed actually, because I think it was like this in the version that I had. And when I read this, I was asking myself, so why are these borrowers being located in Russia of particular concern? So I understood that this includes borrowers of Russian nationality, but it also includes borrowers that are subsidiaries of international, multinational firms. As it's a standard contractual feature that that loans to subsidiaries of multinationals, that if these subsidiaries cease to exist, that these loans become a liability of the borrower. So it's not really clear to me why loans towards multinationals become more risky in this setting. One reason could be that these exposures to the Russian market are so material for a majority of banks, or for a large number, for the treated banks, that markets would react to this. So to understand this a bit better, so from the paper I saw that 1 in 5 banks seems to have this kind of treatment exposures. And I would like to see, or I would like to understand better what's the share in the portfolio of these banks. So how important is this treatment for the individual banks? I took a brief look at Dialogic data, so you're using DealScan, but I had access to Dialogic data that I worked with earlier, and I saw that that a small number of banks with a rather small share of loans was exposed to borrowers located in Russia. So when we talked about this paper earlier, I understood that you consider stigma as a major reason for this market reaction. But I'm wondering whether markets really consider stigma more than the actual risk. Maybe to substantiate the points that you're making, what you could do is that, you argue that markets penalize lending to Russia. So in turn, they maybe would reward if banks reduce their exposure or end their lending to borrowers located in Russia. So you could take a look at this opposite effect, just to confirm the assumption that's underlying your treatment variable. Then I was wondering why you focus on Russia, on borrowers located in Russia only, but I think you extended this to borrowers in the whole region. And also, I was wondering whether an adequate, or whether it isn't a major risk for banks to be exposed to firms that have a significant share of their operation, let it be measures in turnover, let it be measured in returns, or also exposure via FDI, whether these firms these borrowers wouldn't be a risk for the lending banks. This is super difficult to explore, but maybe it could be done on a more sectoral basis. Then now turning to lending and the shock related to lending. So you argue that in general, the risk aversion or the general increase in risk aversion or uncertainty around the time of the invasion is the reason for the change in the lending behavior. And I agree with it. I mean, on the left-hand side graph, you see that here around the moment of the invasion, there's certainly a level shift in this economic policy uncertainty index that is provided by Baker Bloom Davis. And I mean, this is a global indicator, so it's comparatively small shock here. But if you look at Europe, this shock certainly would be bigger. However, I mean, this shock affects the banks and the borrowers to a different extent. And I wonder whether you measure, I mean, the results are very robust and significant, but maybe your dummy variable captures something else. Maybe this exposure to Russia is rather a proxy for a certain specialization or for a certain bank business model. So borrowers that are active in the Russian market, they may be active in certain sectors, maybe with a relation to the energy sector or to minerals, or I don't know exactly. And these kind of sectors, this kind of specialization or this kind of specialization of the banks and the different affectedness of different sectors may be the actual risk that banks are exposed to. So just to substantiate this view, I put the euro area energy prices, and we see a huge jump around the time of the shock in the data. Then turning to the bank's lending. I mean, we heard yesterday that bank lending is the main source of finance in Europe still. And I think that you have very nice and multidimensional data at your hands, and that you could exploit this a bit more to shed more light into these real financial linkages and the implications for the real economy. So I'll skip the first point. One thing is, for instance, that you look at the implications on the intensive margin only. So you look at the size of the loans extended to borrowers. But how is it about the extensive margins? So do banks extend more loans or less loans? They extend less loans. Yeah. So this would be interesting, I think. Also, I mean, if they reduce their lending, do they do this equally across countries and sectors, or do they do maybe the effects of the war? Do they spill over from a directly affected sector to a previously unaffected economic sector via the banks? Or is there maybe a home bias? So do the banks focus more on lending to their home market? So I collected some more minor points that I will skip. Overall, I'd like to say that this is a very interesting question and a very good setting to explore. And I think that the data that you have is very rich, very multidimensional. Exploit it more. And yeah, I wish you good luck with the paper. I know it's part of your PhD, so good luck for your PhD as well. Yeah. Thank you.
Thank you very much, Ursula. So now maybe we can give you a few minutes to react to this, and then we will open the floor for discussion.
Maybe a quick response. So we focus. So the relevant feature in terms of the exposure is the headquarter of the firm. So we don't, of the borrower. So we don't look into the geographic location of their operations, but rather their nationality in terms of the headquarter of their head office. So that's the first thing. But I think also looking at location could be interesting, but then we're a bit constrained in terms of data. So that's an issue there. What I also found a very interesting suggestion is looking at the opposite effect. So in terms of being penalized for being in Russia, maybe being rewarded for exiting Russia, that could be an interesting interesting angle as well. What I didn't think about, but I see why it's relevant now, is the specialization, especially into the mineral sector or to energy-intensive sectors. So that's really something that could play a role here, that I also seen in literature that plays a role. So that's something we really need to investigate as well in order to factor out that this is the driver of the results. Then for lending, I agree that there is some room to do more there. Looking into the extensive margin is something we haven't done yet, but is also on the list of things we need to do also across countries, sectors. But of course, in some specifications could be a bit challenging in terms of data. But overall, thank you for the suggestions.
Okay, thank you very much. So now we can open the floor for the discussion. Jan?
Thank you very much. Hi, I'm Jan Klača from the National Bank of Slovakia. First of all, I have to say I'm very happy that there is research on geopolitics that's not using the geopolitical risk index of Kardar and Jakovel. It's very good. Not that that index is bad, just there are plenty of studies relying on that. And one or maybe two questions, comments related to the cost of equity and the impact on lending. So based on your slides, what I understand is the impact analysis on the cost of lending is based on a 8 weeks plus minus window, and what you showed in the impact of lending is plus minus 1 year. So if you can confirm that there is still a difference in the cost of equity even in this like 1 year period, if it's aligned, and if it's worth like looking on the impact of the difference in the cost of equity. And second point is I think this result that the capital buffer is a bit more important. For me, it's kind of a logical outcome because the overall own funds of the banking sector is only partly made up of equity. So there is a large part, for example, made of retained earnings, and this is exactly what was maybe one of the drivers of the capital or the own funds in the period after 2022, because after the monetary policy tightening, the profitability of the banks were really good because of increasing interest rates. So there were long discussions about how this tightening will impact the profitability, but overall the impact was very positive. So maybe here only a question if you have looked on maybe the difference between the profitability of the banks and maybe its impact on the own funds, and then maybe on the lending, because this can be one channel which is very important after this 2022 period. Thank you very much.
Yeah. Let's collect also from Rainer. I don't know if there was any other question. Two more. Okay, we collect the questions and then.
Okay, yes.
Okay, Rainer Martin, National Bank of Slovakia. So first of all, thanks a lot for the paper, super relevant. I mean, I don't think there's any monetary policy statement without the reference to geopolitical risks and actually looking then what that means. I think that's very, very useful. I have two questions. One of them is probably very, very basic, but why do you focus only on syndicated loans? Why do you not look at other loans? Because that probably is the larger share of the whole loan portfolio. And the second question is, so in financial markets, often you have uncertainty spreading from an individual bank that seems to get into trouble, and then it affects the whole country, and then maybe the whole region. So in your case, a lot of people are very worried about Raiffeisenbank, so that would have impact for the whole Austrian banking system first, and then it spills over. Is this chain, is this something that you looked at or that you could look at with the data and the framework you have? Thank you.
Yeah. Jochen, please.
Yes. Okay. The treatment variable seems to be continuous. It's exposure, so why don't you exploit this a little bit more? You seem to be using dummies, but it seems natural to use the continuity. And why, given that it's listed banks, why don't you simply focus on the initial impact on the stock price of those guys? If the stock market tanks for them, that's a clear indication that something's going on. And then last question is, you sometimes refer to also in the conclusion that there are some negative effects, but do you really show negative effect on aggregate lending? Because it's a diff and diff setting. So maybe the other banks simply pick up the slack and expand, so the differential is there, but as far as I've seen, I've not seen anything that suggests that this is an aggregate effect.
Yeah. And Ernst, please.
Thank you very much for this excellent paper and really topical paper. My question is this. I mean, one aspect is whether a bank is exposed to Russia or Ukraine or such crisis countries. Another aspect is whether the exposure to these countries has been written off. So once you have written the stake off, it's I mean, it should no longer be relevant because it's gone, it's worth zero. So whether you have incorporated this idea or whether you can do so. Thank you.
Okay, thank you very much. So now you can answer.
Yeah, maybe on the last question, no, we don't look into the behavior of the banks in terms of writing off exposure afterwards. That could be interesting also based on the point you made to look whether the reverse holds. So are they rewarded when exiting Russia? So as maybe the first point on the cost of equity, so we see that the impact vanishes over time, but it takes a year or something. Or half a year, depending on the measure of cost of equity, because depending on specification, you could, the effects in terms of how long it stays can be a little bit different, but the effect really, it stays but not forever. So it vanishes over time. That's why we also expect the lending impact to vanish over time. As for the profitability, of course, in setup we control for profitability. However, profitability could then, of course, have an impact on capital, which is why we find that capital is important. Now, besides from that, cost of equity is still relevant because banks cannot perfectly offset an increase in cost of equity in terms of their funding costs. Because of regulation, etc., they are bound to a certain amount of equity. So that's why still we believe it would be relevant to look into the cost of equity. Another question, why we only look into syndicated loans. Unfortunately, the data we have is only syndicated loans. Otherwise, I would definitely integrate it, a larger portfolio of lending and assets as well. But in this setting, we only look into syndicated loans, but we believe it is a proxy of the overall exposure of banks. Whether the exposure of a certain bank in a country can spill over to the whole system, that could definitely play a role indeed, but I'm not immediately sure how we could capture that. But that's also something to take into account because maybe we have for the moment in the paper, we look to isolate it to this issue. But thanks for the suggestion. So for Jochen's comments, what we do in a new version of the paper is we also look into continuous exposure. And there we find that in terms of cost of equity, it does matter, the size of the exposure. But in terms of the impact on lending, it's more the extensive margin that plays and not the intensive margin of exposure. But that's also then the issue if you look at the continuous measure, you only look into syndicated loans, which is only a small part. So, I mean, that could be difficult to if you look at the extensive margin, you could say, okay, if you're exposed in syndicated loans, probably also you're also exposed when including the whole portfolio of assets. But whether you can just assume that the continuous measure also holds, that could be a bit tricky. So that's an issue there. For the stock prices, we believe that the cost of equity is a better measure of the cost of equity than stock prices, because stock prices include a little bit more noise, which you try to filter out with cost of equity in these models with earning expectations, etc. And then also whether the impact is a relative rather than an absolute effect in terms of the aggregate credit supply. That's something we need to look into as well. That's not in the current version of the paper, but thanks for all the suggestions and questions.
Thank you very much. And now we are exactly on time to start the second presentation. So I would invite Falko Fecht to present the paper on the geopolitical shock to bank assets and monetary policy transmission. And Falko is also from Deutsche Bundesbank. So 25 minutes.
Thank you very much. And thank you very much also for having our paper on the program. It's really a pleasure to be here. It is still very much work in progress, so it's actually the first time that I'm presenting the paper, so I'm really excited to hear all your comments, and in particular also Miguel's discussion, so that will be extremely helpful in, I think, putting together the new version of the paper. I also have to apologize to Miguel, because as we are still working on the paper, there might be some results also popping up in the slides that haven't been embedded already in the paper, so I apologize for that if this is really the case. I said the paper is joint work with Stefan Kreppmeier and Björn Iberovic, both from the Bundesbank, and that also means that also the disclaimer obviously applies. And this is indeed, needs to be taken serious, because actually, as you might notice, some of the points that we make in this paper are really at odds with some of the official positions of the Bundesbank, that at least the Bundesbank had at that time when the geopolitical shock hit the European economy. So take that all with a grain of salt, please. I think Emil already prepared the ground largely for the topic overall, right? So I can, I think, be relatively brief in motivating our paper. And maybe the bird's eye view of that paper is that we had now 3 decades of globalization, which increased interconnectedness and interdependencies. But as we now start to learn, right, this also means that geopolitical tensions, if they increase as they are currently doing, right, it will also lead to elevated geopolitical risks and lately even to materializing geopolitical shocks. And so from a bird's eye view, what we are now realizing that we need to understand much better what are the effects overall of geopolitical shocks in such a globalized and interconnected world. And one particular aspect of this is how are banks affected by these geopolitical shocks, especially if they hit directly their assets. And from a central bank's perspective, what we also need to understand, obviously, is what are the implications for monetary policy of that, right? Does monetary policy transmission change if we have geopolitical shocks hitting banks assets, for instance, right? Does that make monetary policy more effective, less effective? We probably don't know all of that yet, right? So that's the bird's eye view. To be a little bit more specific, what we do in this paper is we also look at the same geopolitical shock that Emil was also elaborating on. So we use also the invasion of Ukraine by Russia in 2022, right? And typically, I think the conventional wisdom of the impact of this geopolitical shock was it led to a soar in energy prices, right? So a supply side shock, and typically, as we would argue from the central bank perspective, is that for supply side shocks, we typically follow a look-through approach, right? As long as inflation expectations are well anchored, as long as we don't have wage price spirals, we wouldn't respond to that, right? But that, of course, largely ignores that potentially there are also demand-side effects of these geopolitical shocks, right? So if the demand is also affected, right, then potentially this conclusion is a little bit challenged, right? And what we do in this paper, very similar actually to Emil, is that we show that European banks, or euro area banks, with high credit exposure to Russian and Belarusian borrowers relative to their equity, right, indeed paid after the shock a higher rate on uninsured deposits, so their cost of funding also increased. We look at the deposit side. We see that banks then also cut back their lending. We use UnCredit rather than syndicated loans data, also to domestic non-financial firms. And what we also see, and this is probably the monetary policy perspective, is that banks became more sensitive to changes in monetary policy rates. So banks that were more exposed to the geopolitical shock responded more sensitive to the increase, the monetary tightening that happened after the geopolitical shock, after the invasion in Ukraine. So it seems that therefore monetary policy becomes more effective if there are geopolitical shocks hitting part of the banking sector. So what that means is that we basically find that, this balance sheet channel, basically, that we identify, hopefully, in our work, causes a silent monetary policy tightening through the balance sheet channel and through this increase in banks' refinancing costs in the unsecured deposit market. Okay, so let me quickly walk you a little bit through the data that we have available. We used, for most of our analysis, transaction-level data to do a Quadrant-Meehan approach and identify the effect thoroughly. So for the liability side, for the deposit market, we use the MMSR, transaction-level data of unsecured deposits from non-financial firms to banks in the euro area. And this is limited to only the 28th largest banks in the Eurozone. And there are only relatively few non-financial firms that maintain deposit relationships with at least 2 of these 28 banks. So we have only 53 firms that have multiple deposit relationships with the banking sector in our sample. So that's relatively limited. Of course, we look also at the external validity of our analysis in order to make sure that this is not only driven by these 53 firms in our sample. Overall, however, these unsecured deposits from non-financial firms in our sample account for roughly 10% of those banks' total assets. So it is a sizable amount of the liability side of the banking sector. On the asset side, the transaction-level data that we use is not syndicated loan, it's the ANA-credit data from the ECB, so loan-level data, I think we heard about that already yesterday, right? That has a reporting threshold of 25,000 euros of loans to the non-financial firms. Again, we resort here to the 28 banks that we have also in our MMSR data, although, of course, ANA-credit covers way more banks than these 28, but we want to link both analysis together, so we resort to these 28 banks. In ANA-credit, we have 68,000 firms that have multiple bank relationships, so here we have a much broader sample, and overall, these loans to non-financial firms account for 13.5% of those banks' total assets in our sample. We also use, if you want, transaction-level data from the security holding statistics, which reports the bond holdings of euro area banks in their portfolio. We use that data in particular, however, to identify also exposure to Russian and Belarusian firms. In order to look at the external validity of our analysis, we then also use different bank-level data. So the ECMI statistics, the interest rate statistics of the euro system, which reports on aggregate for different types of deposits and loans, the interest rates that banks are paying. Here we cannot identify the counterpart, right? This is aggregated up. So therefore, we cannot do a Quadrant-Meehan approach here, but still we can look into whether the effects also prevail at this aggregate level. Similarly, the IPSI data, the International Banking Statistics data, provides us with a lot of bank characteristics as control variables that we need for our analysis. Quickly, the sample ranges obviously from shortly before the invasion to shortly after the invasion in order to identify the effect. All right, so just to remind you, the invasion was 24th of February 2022. We follow a very similar approach as Emil does. We use the exposure of banks in ANA-credit, right, and with the security holding statistics to Russian and Belarusian firms, so credit claims that those banks hold in their books, but we put that into relation to the book value of a bank's equity. Right, so how much of their equity is actually at risk with the credit exposure that they have to Russian and Belarusian firms. And then we also use a dummy variable, basically. Banks that have a high exposure are those that have more than 2% of their equity at risk in Russia and Belarus, whereas all banks that have an exposure lower than these 2% are not exposed in our analysis, basically. Okay? So let me then first turn to our analysis on the deposit side. So what is the impact of the asset shock, of this geopolitical shock, on rates and volumes to these uninsured deposits from non-financial corporations? So what is the hypothesis? Probably to put us all on the same page. So the idea here is that a higher exposure increases the failure risk because more of the equity is basically potentially wiped out. And that increases either the risk premium that uninsured depositors will charge, or it will induce these uninsured depositors to withdraw. And what I'm showing you here is basically some local projections results, right? The upper panel is basically the deposit rate, and the lower panel is the deposit volumes. So what we see is basically that only the pricing of these deposits really respond significantly to the geopolitical shock. Exposed banks indeed pay a significantly higher interest rate on their wholesale deposits as compared to non-exposed banks after the invasion. For the deposit volumes, we do not really see a significant result within these local projections. Just to confirm these findings, we also do a simple diff approach with Quadjan-Mian, sequentially saturating the model with different fixed effects. And as you can see, the coefficient of our variable of interest, so the interaction between the post-invasion dummy and the exposure dummy, remains relatively stable, both in size and in significance across the different specifications that we have. In terms of economic significance, what do we see? The exposed banks pay, on average, a 5 basis points higher deposit rate on these unsecured deposits compared to an average of minus 56 basis points that banks were paying overall in that market at that time. Right? So it is about 10% higher refinancing costs in the wholesale deposit market that those banks pay. That is, these here are now the results for the quantities. As we also saw in the local projections, we don't have any significant effect here. Right? However, if we look at the weighted least squares, surprisingly, all of a sudden, these results become significant, when we're still a little bit struggling understanding these results, what is driving these heteroscedasticity, or the fact that controlling for heteroscedasticity using weighted least squares all of a sudden gives us significant results. So that's still something that we find puzzling, and we're trying to tease that out more thoroughly. Overall, what we then also do is we look at the probability of obtaining deposits, right? The extensive margin, if you want. But here we also see basically no strong significant result. It's marginally significant effect here. So that confirms that on the quantity side, results are not really driving, or the geopolitical shock does not really drive the quantity of available unsecured deposits. It's rather driving the pricing. Results then are also confirmed if we look at the ECMI data, so the aggregate data at the bank level for the different deposit classes. So here we again see that the geopolitical shock leads to a significant increase in deposit rates that exposed banks have to pay compared to unexposed banks. And this happens also across the different types of deposits that we have in the ECMI data. Now turning to the loan side, the asset side of banks, right? So here, first of all, we can have several hypotheses. The higher exposure can lead to wiping out of some of the equity, right? Or the bank at least anticipates that some of its equity will be wiped out. This reduces the risk-bearing capacity, and as the risk-bearing capacity is reduced, they might also increase the lending standards and provide less credit or only at a higher rate. But an alternative effect might also be that the higher refinancing cost that we saw in the deposit market might also induce the banks to tighten their credit standards, charge either higher lending rates or refuse to supply credit in the first place. Right? So again, we have here on the left, on the right-hand side, from your perspective, the local projection results. And surprisingly, what we have here is that the loan rates are only marginally significant. So the pricing in the loan market is only marginally significant, whereas the quantitative results, the loan volumes, they are relatively strongly significant also across our other specifications. So it seems that banks are rather rationing credit supply instead of charging significantly higher rates. And that is also confirmed if we run a standard diff and diff approach, fully saturated with fixed effects. So for the volumes, we have relatively consistently significant results that the loan provision declines, but for the lending rates, we don't have any significant results. Now the question then is, what is actually the channel that is driving these findings, right? So is this indeed a pass-through of the higher deposit rates that causes, that's caused by the loan losses and that induces banks to ration loan supply? Or is it the alternative story that banks just become more cautious because some of their equity is being wiped out? So in order to look into this a little bit further, what we do is we use the change in banks' wholesale deposit, the weighted average interest rate that they have to pay in the wholesale deposit market, and use that as an explanatory variable to estimate the loan provision, the loan supply, right? And the results are reported on the right-hand side. So after the invasion, we see that the increase in the deposit rate that banks are paying plays indeed a significant role in the quantity of loans that a bank is supplying, controlling for the demand with the Quadrant-Meehan approach. Right? So it seems that therefore stronger deposit rates indeed induce banks to provide smaller loan amounts to restrict their loan supply to their borrowers. And that is basically confirmed also if we use different event windows around the invasion and so on and so forth. Right? So that is all consistent, I think, with a classic bank lending channel. Right? So the next question then is, if this is true, and that is something I think that Jochen already alluded to, right? If this is true, it might mean that indeed borrowers cannot obtain credit from the exposed banks, but why cannot they simply substitute and go to other banks, right? So is there indeed a real effect that borrowers are cut back, are short in credit provision from overall lenders, and does that also have a real effect? Given that we want to talk about the demand side effects, we also have to somehow look into the real effects of this credit restrictions. So we look into whether the restricted loan supply of exposed relationship lenders, so we now look at the firm level, and we aggregate how much of a firm's past credit provision was provided by exposed lenders. And then we look into whether banks that have closer lending relationships in the past to exposed lenders will have an overall decline in their credit, in their borrowings, in their total borrowings, and whether that will also have an effect on real outcomes, investment decisions, turnover decisions, and employment decisions. And the results are basically summarized in this table here. So what we find is that firms that have a higher weighted exposure to banks that were affected by the geopolitical shocks, they indeed have, after the invasion, a lower credit uptake in total. We do not find effects on the number of their employees, but we find that their total assets are also going down, are decreasing, and also their turnover is declining. Right? So that suggests, at least, that there is indeed some real effect of this credit, the shortfall of credit supply. So that is indeed consistent with the demand side channel that is caused by the geopolitical shock. Right? Just to summarize the findings that we therefore have along those lines, we find that more exposed banks experience tighter refinancing condition, and as a consequence, they ration also their credit supply. Effects on banks' refinancing costs here is equivalent to a 48 basis points increase in monetary policy. We calculate these figures using using an established approach here, using the full distribution of the exposures. So it means that indeed we have here something like a silent monetary policy tightening, right? The losses of the geopolitical shock that causes asset losses at banks induces them or forces them to pay higher refinancing costs, reduces lending equivalent to a 48 basis points monetary policy shock. Right? And that also leads to a reduction in real economic activity. So therefore, we indeed seem to have also a demand side effect. And quickly, in the last few minutes that I have, I also want to quickly look into the sensitivity, whether the geopolitical shock also affects the sensitivity of banks to monetary policy tightening decisions. Right, so does the geopolitical shock affect the sensitivity of banks' refinancing and lending conditions to monetary policy shocks, monetary policy tightening? So here the idea is basically that a higher exposure lowers the net asset value of a given bank after the invasion. They have to write off larger parts of their loan portfolio relative to their equity. And a lower net asset value makes banks more sensitive makes the external finance premium more sensitive to interest rate changes. Right? So here we look at the sample after the invasion, basically, which encompasses 5 monetary policy changes. And we basically use both changes in the deposit rate at the ECB and the well-identified Jaroczynski-Karady monetary policy surprises in order to have better identified monetary policy shocks. Again, we look at the transaction level data from our MMSR statistics and ANA credit, but now we aggregate that up at the quarterly level, at the monthly level, in order to run standard local projections at the daily level. I think this would be a little bit over the top. So, do more exposed banks, deposit rate, respond more sensitive to monetary policy changes? Is the first question that we try to answer. And we said, look in the top at simple changes of the deposit rate of the ECB. And in the lower panel, we look into the more thoroughly identified monetary policy surprises a la Jaroczynski-Karady. But for both figures, for both measures, we find that banks' deposit rate is indeed more sensitive if they were more exposed to the geopolitical shock, and their deposit rate increases more in response to a monetary policy tightening. So for instance, 100 basis point increase in the monetary policy rate, right, would lead to 40 basis points additional increase in the refinancing costs of exposed banks. So it's indeed quite substantially more sensitive to the shock. On the asset side, so loans, right, we have a relatively similar picture. Right? So exposed bank loan rates is also more sensitive after the invasion. So here the effect is slightly less economically significant. Right? Here we find that a 100 basis points increase in the DFR would lead only to a 30 basis points increase, an additional increase of 30 basis points at exposed banks compared to non-exposed banks, which is still, I think, extremely sizable. So to summarize that up, what we find with regards to the sensitivity of monetary policy to monetary tightening, What we find with regards to the sensitivity of banks' lending and refinancing costs to monetary policy tightening, we find that more exposed banks pass through of monetary policy rate increases becomes way more sensitive. So the geopolitical shock did not only impact banks' funding, which negatively affects banks' lending, but we also find that it magnifies the contradictory impact of the subsequent rate hikes that we saw during the monetary policy tightening. We do a lot of robustness checks, but I will not go into the details of that. Just to wrap up, so the geopolitical shock not only impact aggregate supply, but also seems to have an effect on the demand side that lowers inflationary pressures. The effect of the geopolitical shock on banks' refinancing costs is equivalent to an increase in the monetary policy rate of 48 basis points, or roughly 2 interest rate steps, if you want. That's calculated with Chodorov-Reich's approach, as I mentioned. Right? And that means that the geopolitical shock affected banks' refinancing costs and lending rates much more sensitive also to monetary policy tightenings. Thank you very much.
Thank you very much, Falco. And the discussant is Miguel from European Central Bank.
Okay. So, many thanks to the organizers for inviting me to this great conference, also for incentivizing me to read this great paper. I think really, really interesting one. I'm not going to do a big summary of the paper. I'm just going to give a very, very basic, quick look through how I see the main points of the paper. So I see basically 3 big questions. No? Does a geopolitical shock affect bank funding conditions? Does it affect credit supply? And does this affect the reaction to interest rate changes, so to monetary policy? So I think these are the 3 big questions. What are the answers? Basically, yes to all, but a bit more than that. So the impact on funding conditions is both statistically and economically significant. This is important. The impact on loan supply is directly linked to deterioration in funding conditions, and this leads to an amplification of monetary policy tightening. So how does the paper do this? So they have actually very nice data, and I think a very nice also identification strategy. So they really exploit the heterogeneity in the bank's exposure to the Russian invasion of Ukraine. They have daily data, so this really allows to isolate quite cleanly the impact of the shock, while the granular data, as is the standard nowadays, allows for a wide range of fixed effects to really control for demand effects and so on, and get a clean identification. But once again, I think the one thing that is very nice in this paper is the combination of the very rich data set and then the effective way how the authors exploit it. In particular, so we are used by now to seeing many papers with granular data on lending, but it's not so common to see granular data on deposits being exploited in this kind of paper. So this, I think, it's something that's really new and really nice in the paper. Another thing that I think is particularly nice in this specific paper is how the granular data is combined with the more aggregate representative one. Now, as also Falco explained, so that on the one hand we have the tight identification from the loan level data, but on the other hand, we have then the link to bank level data that really covers the full balance sheet and allows to make sure that we are not, just looking at a corner of the balance sheet that might not be representative. So once again, an accredit we are used to seeing. The nice thing, I think, combination of an accredit with using the money market data for the firm deposits, really, I think, novel, and also the combination with the security holdings. So I think worth some, again, some words on that. Now, why is this paper important? Again, I think there was already a lot of motivation, and also it's in this audience, I guess it's clear, but still I wanted to highlight a bit more that, of course, this is at the core of the business of the central banks, and this is visible also, for instance, in the outcome of the recent strategy assessment of the ECB, that really emphasized the importance of the transmission to lending rates and growth that we have observed. So, this affects, of course, the reaction function, but also explicitly in the communication that is done in the wake of monetary policy decisions that we had since in March 23, clear communication on this so-called three-pronged reaction function, really giving weight to the strength of monetary policy transmission that the authors are here directly looking at. Now, the analysis is very representative for the euro area, but the external validity goes beyond that. No? So if we think, also about outside, the FOMC also had in their public communication importance to monetary policy transmission, also to the way how monetary policy affects economic activity and inflation as being at the core of their decisions. Now, in terms of observations, indeed, when we look, this is what is in that chart in the right there, we do see that the drop in credit to firms in this hiking cycle was very sharp. And it was actually sharper than what one would expect if you have a macro model that conditions basically on what would be the reaction that you would expect based on the size of cuts that you did using historical regularities. No? And you see this just based on pure data with which is in that shaded area, but also if you have a model. So, and the authors are kind of addressing why that might be. Also, some other points that are out there, possible explanations, have to do with the overall uncertainty. They have to do possibly with non-linearities, because of course the hikes were very quick and very sharp compared to the past. But here there is kind of a new and very well identified explanation directly linking to this geopolitical risk. So I guess the motivation is really clear that it's very, very topical paper. And with this, I move a bit to my comments or suggestions to the authors. First, on the mechanisms, and Falco addressed this in the presentation. So the authors are focusing here on credit risk. No, depositors are reluctant to have a relationship with a bank because they think this bank is more risky. Can there be another mechanism? Can there be an effect of reputational risk that you might, as a firm, not want to be connected to a bank that is highly involved in Russia? So that's one point. The second point, more generally on channels, is to which extent is this really only about deposits? So you show quite well that there is a link between the deposits and the loans. But then still within this funding cost channel, is it only about or something specific about deposits? Or like, do we expect this to be representative? Would the bond market be different? Also, we have a result on low reaction of ICPF than firm as depositor. I think maybe there would be worth a bit more discussion on why that is. So is it about risk sensitiveness? And if so, could we look, for instance, at investment funds as another agent? And then, in terms more broadly of channels, my question is, again, you showed this tight link with the funding, but this does not mean necessarily that other channels might not be at work as well, right? So for sure funding is there, but can the risk appetite also be there? Can aspects like the bank's internal risk control, supervisory pressure, market pressure mean that there might also be a kind of an effect on credit standards due to banks' risk attitudes, because if so, this could further amplify the impact on credit that you are showing us. So what does this mean for transmission? And this slide, I think, is very much linked to the version of the paper that I read. Many of the things that I'm commenting on here I will skip because they are already done. So, I did get the sense that the paper is much more developed on the deposit and the lending part. That has to do with the work in progress nature of the paper. But I think, again, linked to this point about the different channels, there could be a bit more exercises on differential impacts across types of loans. So this could help understand whether the risk channel is at play. And again, if it is, maybe these 50 basis points that you find are even more. Then there could be a bit more exercises also on the type of firms. Are they smaller firms, younger firms, or productive zombie firms? What are they? In terms of replacing credit, again, you showed already an exercise, real effects as well. Another point that could be worth an extension is also on differences across countries, because this could inform as well kind of an interaction with a bit other literature on fragmentation or implicit public support. And yeah, with this I conclude. I mean, I would have these methodological points I will not go through. Well, maybe just one, because it's a simple clarification on whether the loans to firms that are active in Russia are still included in the sample. In principle, would be they should be out. But yes, I stick to that. Very nice paper. Thanks for the opportunity of reading, and I think it will do very well for sure.
Thank you very much, Miguel. And now Falco can have maybe 1 or 2 minutes to answer so that we have time for questions from the audience.
Absolutely. Thank you very much, first of all, Miguel. Very useful and extremely helpful. Very good points. Thanks a lot. Will definitely help us to revise the paper. I mean, most of the points are just well taken. We have to, I think, extend the paper along those lines. I think, first probably about the cleaning of the data with banks' loans further granted to exposed banks in Russia. I think they are automatically not part of our analysis because we have borrower fixed effects, and none of the banks will continue lending to a firm that is located in Russia after the invasion and after the sanctions were in place. So I think they dropped automatically out of our sample, but we probably should check that again. But I'm relatively confident that our results do not capture or are not biased somehow by these. Bond market reaction, that's definitely something that we haven't thought of. We should look into this. And indeed, it might also be then very interesting to look into the security holding statistics, whether the bonds were held by different types of investors. That's certainly an extremely interesting exercise. Reputational risk to be lending to, I'm sure this is also at play. I'm not exactly sure how to disentangle that. It's certainly an effect that probably is correlated with the write-down of loans. I mean, this, yeah, maybe we just have to capture that and mute a little bit our interpretation, our strong interpretation, which relies on the write-downs of the credit exposure. Risk appetite that might be mitigated, I think this should be something captured by the fixed effects, right? Also, I think banks that didn't have an exposure prior to the invasion will have less appetite to continue lending to firms in Belarus and Russia after the invasion. So I'm quite confident that this is basically being taken care of by our identification. A quick word maybe also on the discussion in the strategy review. We of course also have been a bit involved in, and there exactly was the position of the Bundesbank often that we do not precisely believe this idea that the transmission channel is stronger currently. And I was also indeed of the opinion that because of the higher excess reserves that banks were holding, this rather mutes the transmission of monetary policy shocks, right? And there was also a paper from the Bundesbank showing exactly this, right? So I could not perfectly understand why many of the other central banks were arguing in the opposite direction. But now I'm a bit more convinced by that argument, having written the paper myself.
Okay, great.
Thank you very much again.
Thank you.
Really helpful.
And maybe we can open the floor for the discussion. And I think Ernst was the first. And then.
Thank you for this extremely topical, interesting, and stimulating presentation. I really enjoyed that. And my question is also, I must emphasize, subject to the usual disclaimer. So it has been argued that the ECB's defeat of the inflation surge was so successful because of super high credibility. So with very little, relatively little interest rate hikes, we managed to bring the inflation back down. Now, does your result qualify this view? Was the ECB's tightening actually stronger, silently and through the monetary transmission effect, and thus the fighting of the inflation surge actually more costly than conventionally thought? This seems also to be confirmed or consistent with the gray-orange chart that Miguel showed, which actually showed a quite strong effect of credit. Thank you.
Yeah, and we continue in the first row. So, Rainer.
Thank you very much, and I'm very happy Ernest asked that question already, so I don't have to ask it, because I had the same. But I have two other things. So one point is that when you look at the impact on deposit rates and on loans, so they're statistically significant, but I think relative to, say, financial crisis episodes, they are relatively small. I don't have the figures in hand, but they didn't strike me as super large. Now, by contrast, the sensitivity impact seems very large. And I'm not sure whether you have, whether there is equivalent analysis on other episodes, but I think that would be a very interesting point to look at, how these two things fit together. And the second point I had is, I think, Miguel, you also mentioned, is the cross-country variation. And I think if you look at at such a geopolitical conflict, you would expect that there is something like a equivalent to a gravity model or something like this, right? So the sort of front lines, quote unquote, would be more affected probably than those like you know, like Spain or Portugal. So I think that would be interesting to look at. Maybe you've done it already, but just a question.
Jochen, please.
About you find a volume effect, that loan volume goes down, but not so much on the rate. Are you surprised by that? Because when I was thinking it through, I think like, okay, supply goes down, but there's still a competitive market, they have to compete, so of course you don't find a differential effect. Maybe there's just a level effect because everybody has to pay higher rates because there's less loan supply, but it's not differential between the two group of banks. So the first question. And the second one, the last step I was missing a little bit, can you really pin down an aggregate effect? Because yes, there are some banks that are affected. Yes, you showed that there are real effects, but how big are those banks? What's their loan market share? Will this really feed through and explain the nice graph Miguel has shown? Or is this just ultimately 5% of the total market and probably swamped by some other stuff that you don't capture?
Okay, thank you. Any other questions? Also, people from other rows than first row can ask. Yeah. Okay, if no, then Falco.
Thank you very much. All also extremely interesting questions and very helpful also to sharpen probably our analysis. Maybe on the first question regarding the confidence of the ECB, that it was all the ECB's credibility. I agree also that this is probably not an entirely convincing argument, given that, I mean, if you look at the inflation expectations of households in our surveys, I mean, they were not that well anchored, actually. So this credibility argument might not have such a strong bite. So I think it's important that we also probably look into alternative explanations why monetary policy rate hikes were so effective in bringing down inflation. So I'm absolutely with you in this regards, and hopefully we can contribute a little bit to this debate. Rainer, I mean, definitively what is something that we have on our menu is to look into the heterogeneity across countries, and this is absolutely a straightforward point to take. I mean, the issue is a little bit that we only have 28 banks, right? So there is a limit on how much you can disaggregate along this dimension, but certainly one can look into direct neighbor countries to Ukraine and countries further away and group them into two groups potentially to say something along those lines, and we will definitively do that. I mean, I agree that the rate increases are small relative to crisis periods, and I mean, this is not a paper about crisis. This is not a paper about the interaction of financial stability and monetary policy. I think it is nice to have an event that is relatively minor, but still you see that there is a demand side effect, right? And still you see that also the sensitivity is quite substantially affected. But even though there was no large-scale debate about whether we have to bail out the European banks in order to combat the impact of the crisis and so on and so forth, right? There was no debate about financial stability, but still the asset or the bank lending channel was at play here, right? So it was not economically that significant, but there is, at least statistically, it was there, and it contributed apparently to somewhat to the tightening. And Jochen, definitively we have to dig further into the story whether it really has an impact on aggregate demand. That point is well taken. I mean, I think we took already a step forward compared to the version that Miguel had, right? That we are now able to at least say something about the real effects. But certainly we have to put that into perspective. How large are the firms' turnovers relative to the full population of firms? How large is the credit uptake of those firms relative to the overall population? That is something that we haven't done, and we certainly need to look into that as well.
Great. I think we are done. Okay. Thank you very much.
Welcome to session 4. We're now dealing with firms' financing behavior. Our first paper, which is entitled From Financial Stability to Real Investment, the Confidence Channel of Monetary Policy, sheds new light on the impact of macroprudential policies, which, you know, the traditional perception is that macro-pru tightening leads to a tightening in the economy as a whole through tightened financing conditions. But this paper brings in a new aspect by introducing to us and investigating a confidence channel, which might actually stimulate growth, and then discusses the balance between the two. I find this very innovative and interesting. Our speaker is Stelios Giannoulakis. He's scientific advisor, economist at the Hellenic Parliamentary Budget Office and adjunct professor at Athens University of Economics and Business. Stelios, I'm very interested in your presentation. Over to you.
Thank you very much. Should I use the podium or?
Yes, yeah, you can use the podium, of course.
Or is it better from here?
As you prefer. By all means, you need this device.
Thank you very much. So thank you for the introduction. Good morning, everyone. Thank you all for being here today. And of course, thank the organizers for giving me the opportunity to present part of my work. Well, the main theme we're addressing this paper is macroprudential policy, and specifically how such a policy can affect firm investment behavior. Let me start with, by the way, this is a joint paper with Dimitris Anastasiou, who is also here with us today. Hi, Dimitris. Let me start with a few words about the motivation. Why do we care about macroprudential policy? From a policy point of view, macroprudential policy has become a key element of financial stability frameworks across the European Union, especially after the global financial crisis. More and more European countries use such tools to stabilize their financial system. The discussion has also reinvigorated by the recent, not ongoing, but recent revision of the European macroprudential framework that strengthened the macroprudential tools and ensured a consistent application of macroprudential policy across member states. From an academic point of view, the literature has so far focused primarily on aggregate level outcomes, how macroprudential policy affects aggregate variables such as credit growth, gross domestic product, house prices, etc. The literature has also focused on how macroprudential policy affects credit supply, bank lending, in other words. In this paper, we shift the focus on the demand side and specifically on firms. So what we do in this paper, we ask, how does macroprudential policy affect firm real investment behavior in the euro area? To answer this question, we explore a new mechanism, firms' confidence. On the one hand, macroprudential tightening can, by stabilizing the financial system, can bolster firms' confidence, reducing and thus reducing precautionary cutbacks and supporting investment. On the other hand, which is the most traditional, macroprudential tightening can also dampen confidence by tightening financing conditions and thus discouraging firms from undertaking planned investment. In this paper, we investigate empirically which of these two forces dominate, providing micro-level evidence. Now, a few words about the literature and how our paper fits in it. The current literature has focused on the aggregate economy, how macroprudential policy affects aggregate variables such as business cycle downturns, house prices, credit growth, etc. Also, the literature has focused on how macroprudential policy affects credit supply, bank lending. Our study complements this literature by shifting attention to the demand sides, to firms. We study confidence channels according to which firms adjust investment not only in response to credit availability, but also in response to signals and expectations generated by regulatory tightening. Our analysis has two key dimensions. First, we study investment decisions conditional on firms reporting a real need to invest. This design isolates active behavioral responses, firms that indeed state a real need to invest, but despite that, finally, they do not invest. Although they have the need, they do not invest. They decide to not invest. Rather than mixing firms with firms that have no investment demand in the first place. So we want to isolate firms that indeed have a need to invest, and despite that, they do not invest. In fact, they de-invest, they reduce investment. Second, we employ several layers of macroprudential policy analysis. We start our analysis by using an index for the aggregate policy stance. This is a composite index of 17 different instruments, macroprudential instruments of all types. Then we move by using 5 broad categories of macroprudential policy instruments. We use capital-based instruments, instruments based on corporate credit, on housing credit, liquidity-based instruments, and instruments targeting foreign exchange. Finally, we examine the impact of each individual instrument separately. For each of the 17 available instruments, we examine each impact separately. This layered approach reveals which tools stabilize investment and which may unintentionally discourage it. Now, before I proceed with the analysis, the detailed presentation of our data and methodology and results, let me give you a preview of our key findings. We find that on average, macroprudential tightening reduces the probability of de-investment, indicating a stabilizing effect on firm behavior. This finding supports the idea that financial stability policies can bolster business confidence and mitigate precautionary cutbacks. We also find important heterogeneity across macroprudential policy instruments. For instance, corporate credit-based and liquidity-based instruments are the most effective in lowering the investment risk. In contrast, housing credit-related measures increase the probability of de-investment, likely because they tighten collateral constraints for small, medium enterprises. Finally, we find that capital-based and foreign exchange-based measures have no effect at all. Let me now present our data. This study combines firm level with macro prudential policy data. Our firm level data comes from the ECB survey on the access to finance and of enterprises, the SAFE database. This database provides detailed information on firms' investment needs and outcomes. It also provides information about specific firm characteristics like size, age, the sector in which each firm operates, the owner's status, some information about their financial position like turnover, profitability, and interest expenses. Our macroprudential policy data comes from the IMF's IMAP database. This database records macroprudential policy action across countries and different instruments. Our final integrated dataset combines SAFE and IMAP data matched at country wave level. And this dataset links firm behavior with the macroprudential environment that Eurozone firms operate. Let me give you a few more details about firm level data. Our data covers 19 waves of the survey from 2014 to 2024. We have information, we have more than 74,000 firm level informations, corresponding approximately to 4,000 firms in the Eurozone, in the Euro area. Two are the key variables of our analysis. The first variable is variable question 2 in the survey, which reports whether a firm increased, decreased, or kept unchanged its investment during the past 6 months. The second variable is question 6a, which reports whether a firm had indeed an investment need during the last 6 months. So we focus on firms that indeed have a need to invest, but they decided for some reason to reduce their investment. We also have information about a bunch of firm characteristics that were used for control, age, size, etc. Now, this figure here depicts the share of firms that de-invest for each country, the average share. As we can see, there is a substantial cross-country variation. Also, we find that our data has important heterogeneity across firms. We find that the small and younger firms are more likely to de-invest. And also firms with a worsening financial position, as it is implied by their turnover, their profits, their higher interest expenses, so a higher de-investment rate. Now let's move to our macroprudential policy data. The IMAP database provides information about macroprudential policy actions across 70 different instruments. With the term policy action, we mean either a tightening or a loosening of macroprudential policy. For our analysis, we categorize these 17 instruments into 5 broad categories. Macroprudential instruments based on capital, based on corporate credit or housing credit, liquidity-based instruments, or instruments targeting foreign exchange. In this figure here, you can see the number of the tightening, this is the black bars, or the loosening episodes, this is the gray bars, for each of these 5 categories. As we can see, the tightening episodes are more than the loosening episodes for all categories, and the tightening episodes are, the number of the tightening episodes are extremely high, especially for the capital-based, the liquidity-based, and the housing credit-based instruments. So we construct a net tightening index, which counts the number of tightening episodes. So we focus on tightening episodes rather than loosening episodes. We construct this index for across all instruments. This gives us the aggregate policy stance. We also construct this index for each category separately. And finally, we construct this index for each individual instrument separately. Now, this figure here illustrates the percentage of firms that de-invest across different macroprudential policy stances. As we can see, we have a clear negative relationship between policy stance, the aggregate policy stance, and the investment. Under strong loosening episodes, we have the highest de-investment rate, about 25%. Under mild loosening episodes, the de-investment rate is still elevated, approximately 18%. Under neutral and tightening episodes, we have the lower de-investment rate, around 12%. This preliminary evidence suggests that macroprudential tightening reduces the likelihood, the probability of de-investment, and is consistent with a stabilizing confidence effect. Let me move to our methodology. We use a 2-stage probit model with stable selection. Our selection equation models the probability that a firm reports a need to invest from the SAFE survey, and models this probability as a function of the policy instance, the net tighten index I presented earlier, and as a function of a set of firm characteristics as controls and country dummies. I will explain what COMBET is later. Our outcome equation models the probability that a firm reduces investment, in other words, de-invest, conditional on reporting an investment need. This is very important because without conditioning on investment need, de-investment could simply reflect firms that had no demand for investment, which would bias the results. So we need to focus on firms that indeed have a need, but they decide to de-invest. Now, as controls, we use a set of firm characteristics like size, age, sector, financial position, and ownership. We also include country dummies to capture differences in unobserved differences in national frameworks and macro conditions. Now, the variable COMBET that we included in the selection equation is, in fact, our exclusion restriction. It captures the perceived market competition, and we follow the standard literature here. The idea for this exclusion restriction is that competition drives whether firms need to invest. It does not directly affect the investment once the need is established. So it affects the probability to have a need of investment, but not the probability to de-invest. We estimate our model using a full information maximum likelihood. And since we estimate a probit model, we report marginal effect at means instead of raw estimates. Let's move to our baseline results here. As we can see, the graph here presents the estimated marginal effects of the aggregate macroprudential policy stance and the de-investment probability. As we can see, there is a clear negative relationship between tightening macroprudential policy and the de-investment rate. On average, one standard deviation tightening in the aggregate macroprudential stance across the 70 different instruments reduces the probability of de-investment by 0.7 percentage points. This corresponds to 3.7%, 3.5% reduction relative to the mean de-investment rate. This result is both statistically and economically significant and confirms that macroprudential tightening had a stabilizing effect, lowering precautionary investment cutbacks and lowering the probability of de-investment. Now let's move to our results by each category separately. Starting with the liquidity-based macroprudential policy measures, we find that such measures has the strongest stabilizing effect. They reduced the tightening of such instruments reduced the de-investment probability significantly by 3.5 percentage points. Corporate credit-based macroprudential policy measures follow. They have the second strongest stabilizing effect, equal to 2.6 percentage points. In contrast, in housing credit-based macroprudential measures increase the probability of de-investment by 1.2 percentage points, likely due to tighter collateral constraints for small, medium enterprises. Finally, we find that capital-based and foreign exchange-based macroprudential policies have no significant effect, does not affect the investment at all. So there is important heterogeneity across the type of policy instruments. Let's have a closer look to this heterogeneity. We start with liquidity-based measures who had the largest stabilizing effect. We find that this stabilizing effect is exclusively driven by the liquidity coverage ratio, which strengthens confidence in banks' ability to provide credit. Measures like reserve requirements or loan-to-deposit ratio does not play a role in this stabilizing effect. Moving to the corporate credit-based macroprudential measures, which has the second strongest stabilizing effect, we find once again that the stabilizing effect comes exclusively from loan loss provisioning, which reassures firms on future credit supply. Corporate loan risk weights does not play a role in this stabilizing effect. Moving to the housing credit-based macroprudential measures, which display the destabilizing effect, we can see that borrower-based measures like debt service to income or loan-to-value ratios play no role here. And the destabilizing effects comes from the household loan risk weights. Turning to the capital-based macroprudential measures, which had no effect to the de-investment rates, we can see that here we have mixed results, two effects that interact together. The first effect is the effect of the conservation buffer. Here we have a stabilizing effect, signaling prudence and resilience, reassuring firms about future credit availability. On the other hand, capital requirements about corporate lending had a destabilizing effect. So we have two opposite effects here that play no role in total when we sum them. Finally, moving to the foreign exchange-based macroprudential policy measures, we find that play no role, either individually or altogether. I will finish the results section with a few words about our sensitivity analysis. We did two robustness checks. The first was, in the first, we focused only in the tightening episodes and not the loosening episodes. And again, we found the same results, that macroprudential policy has a stabilizing effect regarding the investment. The second exercise was about the role of the announcement date of macroprudential policy. Macroprudential instruments sometimes undergo an extended notification period prior to implementation. We used a 2-lag period instead of one that we use in our baseline analysis, and the 3-lag period, etc. And again, we had the same results. Macroprudential policy had a stabilizing effect on firms' investment. Now, let me summarize our results again. We find that macroprudential tightening on average reduces the investment and thus supports the existence of a confidence channel. Regulation can reassure firms, lowering precautionary retreat. We find again that there is important heterogeneity across macroprudential measures. Corporate credit and liquidity-based tools are the most effective in stabilizing firm investment. In contrast, housing credit-based tools destabilize investment, increase the investment, probably via collateral constraints, especially for small business enterprises. And finally, we find that capital and foreign exchange-based tools have a significant effect, do not affect investment, firm investment. How do we interpret these results? Macroprudential tools send signals that say firm expectations, and thus affect firm investment through expectations. Our results have also important policy implications. First, we find that the instrument type matters. So policymakers should rely more on corporate credit and liquidity-based macroprudential instruments, which effectively reduce the investment risk. Second, policymakers should use housing tools with caution. Housing-related macroprudential policies can raise the investment through collateral constraints, especially for small, medium enterprises. And finally, a sound practice might be to incorporate safe-type data into macroprudential surveillance to detect and mitigate unintended real economy effects. I will close with a few words about how are we planning to continue this research. Our first aim is to explore more directly the mechanism of the confidence channel. How are we going to do that? By using survey-based trust data to measure firms' trust in banks and in to the financial system in general. And then we're going to examine the role of this variable of trust as a mitigating factor. Maps should increase trust, and this increase must reduce the probability of the investment. Second, we're planning to do some further robustness checks, regressions by age or firm size, by financial position, by credit history, and economic outlook, to see whether our results are indeed robust. Thank you.
Thank you, Stelios. Let me now turn over to our discussant, Maria Siranova, Senior Researcher at the Institute of Economic Research of the Slovak Academy of Sciences and Associate Professor at the Institute of Economics at Comenius University in Bratislava. Maria, over to you.
Okay, so first of all, thank you very much for the invitation from the organizing committee to serve as a discussant to this interesting paper, and also thank you to the authors for writing this interesting and intriguing paper. So at the very beginning of my presentation, I will just very briefly summarize what I feel is the main contribution of the paper and what are the key findings that can be then discussed with the policymakers. So first of all, it's a confidence channel, and it's about the supposedly a new channel that this paper tries to pin down, tries to describe, and hopefully also tries to find in the data. And I will focus in my presentation more on the definition and conceptualization of the confidence channel. It uses a micro-level data, which is, of course, highly appreciated, and it focuses on the demand side of the market, especially on the real firm decisions about the investments, current and potentially also future investments. So from this perspective, this really brings a new additional value to the discussion about the setup of the macroprudential policy that has so far mostly focused really on the supply side of the market. And it also does the disaggregated analysis based on the macroprudential tools. And there I would like to also highlight the focus on the corporate-based macroprudential tools rather than just, standardly discussed capital-based measures or household-based measures. So what are the key findings in the paper? So the macroprudential policy based on the empirical results can have effect on the firm-level decision-making process, especially when they think about their current and future investments. And secondly, and I think this is even more interesting and an intriguing result, the tightening of the macroprudential policy can potentially result in the lowering probability of de-investment. It's not precisely increase in investment, but at least there is this kind of smell of decreasing of the probability of the invest. So some sort of counter-cyclical effect of a macroprudential policy. So firstly, when I received the paper for the discussion, I really started thinking about what this confidence channel entail. How can we approach it since, again, supposedly this is like a new channel of a macroprudential policy and have been discussed in the literature before. The confidence channel should affect the decision of the firms based on the overall macroeconomic impact of a macroprudential policy on the stability of the financial system. And that's also like one of the definitions, of the objective of the macroprudential policy. For this channel to work, we need to have some assumptions. So the first assumption is that the firms are rational players. They really do understand the so-called rules of the game. Are those firms, especially small and medium enterprises, really the rational players that then understand everything? Or is it more about also some kind of smell of rational inattention that is there? So when I look at the data set that you are using, I was directly thinking that without the discussion about the rationality of the firms and the understanding of the firms of the rules of the game of macroprudential policy, I mean, this channel might not really work. So, for example, you actually mentioned it already in one of the robustness checks that you want to do. You would like to look at some kind of bank-level relationship that the firms have in the past, because I think that is one of the channels that can, help the firms to understand the goals and the objectives of the macroprudential policy. Otherwise, we will not say, that the firms will not believe. They will not understand what the macroprudential policy is about. So your confidence channel might not necessarily be in the data. And you have, I would say, you can find some of the proxies of this, let's call it, financial literacy of the firm in your sample. The second, in order for the confidence channel to work, the players of the game, they need to be aware of the measures that the macroprudential policy uses. So you already addressed it partially in the paper by the disaggregated analysis based on the tools. But then, it's not that easy because they need to understand the objective of the macroprudential policy. In this case, hopefully, the firms understand that there is this kind of financial stability in mind. But again, I think even we as researchers, we are not pretty sure what is the macroprudential policy function. So maybe, it's a little bit far-fetched to already assume that the firms are aware of the macroprudential policy function. I am not saying that this kind of conceptualization impair your empirical strategy or the results, but while reading the paper, I really felt that you would like to maybe dig a little bit deeper into the theoretical part of the paper to explain these confidence channels a little bit more. And then, what is the nature of the macroprudential policy? So hopefully, or we think that now the macroprudential policy serves as a counter-cyclical tool, but that might not be completely the case, especially during your data sample that starts in 2014 and ends 2023, 4? 24. Yes, precisely. So In Slovakia, for example, when you look at the data, up to 2020, you basically only had the tightening period. And that was sort of like the adoption phase. So you firstly needed to build some capital buffers, and only after that you could start moving them in a countercyclical fashion. So there is now even a debate whether the zero is true zero in some of the macroprudential, the capital-based measures. So again, I think when you think about this kind of conceptualization, one of the natural robustness check would be also to split maybe the sample between the different phases, like given of the cyclical, that this counter-cyclical phase of the macroprudential policy or the adoption phase of the macroprudential policy. And then, of course, the communication. How do firms learn, to trust? So it's, again, either maybe via some previous banking relationship, and you can explore it a little bit deeper, maybe in the empirically, or, of course, the communication of the macropotential policy is the key. But then, again, there is a huge, it's not yet well explored, so you might struggle to find maybe some references, but it would be nice to have it in the theoretical part of the paper. Now, some notes to your empirical strategy. So you used two questions. So the first one is the selection equation. So in the past 6 months, whether you invest or decided to invest, and then the outcome equation is compared to the previous 6 months, et cetera, et cetera. And even in your paper, you are, it's a little bit tricky to understand what this question entails, because as a output variable, you say that you either did the investment in the previous period or in the current 6 months. So in order for your strategy to work, there should be overlap. So the question, the selection question, the 6 months, should overlap also with the outcome question. But unfortunately, because of the phrasing of the question, even in the outcome equation, you can have some information from the t-2, actually, rather than or t-1 that you have as an outcome equation. And when I think about the mechanics of the identification strategy, that can pose some tricky issues. So for example, you have this kind of, for example, when monetary policy action in the, like t-1 causes firm to, obtain a loan and increase the amount of investment, that would be the natural response. But then basically in your current month, at the month when the question of the survey was asked, you can actually have some portion of the responders to ask that, yes, when I compare it, with the 6-1, I already received a loan, and now I have a feeling that currently in this month, I will do the investment, because I actually obtained the loan in the t-1, so I don't need to obtain the loan. So my natural response would be that, of course, I will maybe lower the amount of the investment, because I did some of the investments already in the previous path, in the previous period. So the question is whether in your identification strategy, or the data basically that you are getting from the survey questions, whether there might be not some portion of respondents who are actually answering that now they decrease or they lower investment because they were successful in getting the loan in the past. So standard, credit channel. And then you can have it even more problematic, because basically this would be this kind of forward-looking or just a simple reaction. So in the t-1, you obtain the loan, and because you obtain the loan, then you decrease your investment in the following period, and that is precisely what you are actually capturing also in the outcome equation, if these both answers are sort of like a valid that you have there. So at some point, you would like to maybe exclude even this possibility, with your empirical strategy. So when I was thinking about it, I think I would like to maybe give you some clues that you could maybe try. So for example, in your question number 2, you have some of the firms that basically reported no answer in one of the questions. So I was like, I would like to see like how these, the portion of the first that reported that this answer for the question number 2 is not relevant for them overlaps with the number of firms, but those are the same, the firms that already said that we invested, you know, in the previous period. So maybe some sort of still cleaning of the sample. I think, you know, then what you can look at a little bit more is basically to see whether there was some kind of past banking relationship, you know, and basically whether this kind of whether, you know, the second option or the third possibility is even there in your sample. Because when you had some previous banking relationship and you were successful, you know, to get the loan, that would have been a natural response to decrease, you know, the investment because it was already funded in the previous period. Interestingly, your robustness that you do by increasing, you know, the monetary policy to T-2, that actually contributes or maybe even captures, you know, the third option that you have there. Then you are just responding, you know, to the question, to the outcomes question, by saying that I decrease investment because you were already successful, you know, in the T-2 or T-1. So interestingly, I think that there are still some empirical strategies that you can take into account to maybe really narrow it down, to rule out, you know, the possibilities to really make sure that the responses that you are getting are really as a response to some kind of, not the previous banking relationship, but to reaction to the macro-financial environment that you have there. I think those are just like minor comments that you can still introduce, but I would like to maybe just only very briefly focus on on this kind of heterogeneity analysis that you already suggested that can be still, you know, a part of your paper, especially the heterogeneity with respect to the characteristics of the firm size. I mean, because that nicely plays to this idea that in order for a confidence channel to work, the firms need to understand, and maybe the micro firms, you know, they really are limited in the understanding of all the macroprudential tools in comparison to some other small and medium enterprises. I think, again, to somehow address this previous bank relationship might be crucial for you. So you can even maybe focus on the firms who report no past banking relationship, because if those firms still react to macroprudential easing on tightening, for me, that would be the cleanest and robust example of confidence channels, because even if you don't have a direct link to bank, you still understand that something is going on in the macro-financial environment caused by the macroprudential tightening or easing. So this might be, in some sense, an ultimate proof that the confidence channel works, even on the firms who are not with the bank relationship. And then, of course, some other robustness checks with respect to maybe monetary policy, some placebo test by randomization of the outcome variable, et cetera, et cetera. So I think those are easier to implement. But again, to summarize, I think this is a very important paper because it focuses on these real economic decisions, and it uncovers a new confidence channel. But I think this kind of conceptualization would even make it, the argument would be even stronger and in order to convince the reader. Okay, so thank you very much.
Thank you very much, Maria. Stelios, opportunity for comments.
For comments from the comments, yeah.
Yes. Replies.
Thank you very much for the comments. That is a really good feedback. I don't have comments. I will take into consideration all of them. I like very much the comments about this robustness check about using firms without past bank-firm relation. This will indeed strengthen our argument. Now, about the different phases of macroprudential policy measures, we did a robustness check like this without having the losing episodes by focusing only to the tightening episodes. The communication of the macroprudential policy, I agree, it's very important. Again, we did a robustness checks about the announcement date. I don't think that we can do much more here. Regarding the timing of the need to invest, the time when firms report a need to investment, report that they decrease or increase investment, again, here we have a problem because it's a survey. We don't have a time dimension. It's only a wave. So taking lags to this variable is a little bit problematic from an econometric perspective of view. But again, it's something that we have to take into consideration. That's all. Thank you again very much for your comments.
Thank you. We have time for 1 or 2 questions. Yes, please.
I have also a comment.
Thank you very much. Thank you very much for this presentation, because this is, I would be very happy if we can prove that this channel works, because it's always good to show that macro policy can work in a way intended. But it's very hard because it's very difficult. In case if you are focusing really on SMEs, then a lot of questions comes out. Just a few. So first, in general, macro policy should be counter-cyclical, which means that most of the tightening should be in a booming phase. And this is, I guess, also much in line with the chart you show at the beginning, when the lower share of firms that investing was in the times of the most significant tightening. So I would really expect this picture to be there, and therefore you should be also very convincing in showing that you just take care of this overall probably boom period, and you when you identify the impact of macro policy on the decision of firms. I guess you take into account, I didn't get fully, I saw there are some country fixed effects, but I don't know if there are some country time fixed effects or whatever, that you can at least show that, yes, we are taking care of this overall economic cycle. And the second is also that there are a lot of macro measures in the overall index, and some of them have no connection to the SMEs. That was also visible from the estimates based on macro tools, that some of them were significant, but a lot of them were not significant. So maybe a question that what share of this overall tightening and easing that you showed was really significantly impacting the NFCs, the SMEs decision. So how large is the pool of macro measures we are talking about, and in this case, if it's possible, just to shrink also this overall index and to only those few measures that are there. And then again, I would really again echo what Maria said, that then I guess some theory or something to convince that this is a channel that should work in this case of measures would be very interesting. Just one example. So the increased risk weights for housing lending, I don't know how much it impacts directly SMEs, to what extent they are taking these loans, or to what extent it's just a kind of a second round effect through maybe a dampening impact on the demand for housing. And also the liquidity coverage ratio, I'm just thinking about, but at the moment I cannot really think about how this exactly works, so how much of these SMEs even know about this liquidity coverage ratio. So it would be really very interesting to have some more deeper insight how this channel can work. And then, as I said, it would be very, very, very nice to have this convincing evidence. Thank you very much.
Thank you.
Thank you, Jan. Would you like to comment?
I have a comment.
Yes, please, go ahead.
Yes, just a comment on the paper, because I found very interesting, but some of the results need to be digested a bit. And the one is that I saw, it was on the counter-cyclical capital buffer, because I have a paper that we are working on that, on the loosening of the counter-cyclical capital buffer. We link also with the banks. And what we find is that the firms are telling us that they are expecting an increase in availability of bank loans. Okay, I didn't check what it means in terms of investment, but it's most probably that if there is an increase in availability of bank loans, you are going to invest more. So I would like to know whether you have looked also this channel or the availability of the bank loans within the survey. The variable, I mean.
We didn't, to be honest. We didn't, but it's a very good idea. Yeah, we have to do it.
Yeah, okay.
Very quickly, following up on Maria's question about investment, maybe you can actually check in your data, because we all have the notion that investment is a lumpy thing. You do it once and then you don't do it for 2 years, and it might exactly be happening what she says. But in your data, if you just plot the time series, how often you have, is it lumpy, or is it maybe the firms respond that they always do a little bit, then the concern wouldn't be that big. So just, you can check in on your own series. Mm-hmm. And the question I have is, can you explain a little bit better the exclusion restriction and why competitive situation affects the probability, but not then the second stage? Because that's wasn't clear to me. I did not understand the argument there.
Yeah, the exclusion restriction is the perceived market competition. We follow the literature here. It says that the way you understand the market competition affects your need to investment, whether you need or not to invest, but not your decision to invest or not. Because if you have a need, you have the need to invest in order to deal with the competition. The need to deal with the competition creates the need to invest. But if you have this need, you are going to invest. Competition does not play a role if you invest or not. It will play a role to decide to create a need for you to invest. Okay.
Okay, so thank you very much. So you see your paper triggers a lot of interest. Let me now turn to the second paper on bank loan application and access to finance by European SMEs, which investigates what factors drive SMEs loan applications and what factors actually might discourage them. Our speaker is Florian Horky, a senior research economist at the National Bank of Slovakia and postdoctoral researcher at the CEPS Center for Sustainability Research at Zeppelin University, Friedrichshafen. Florian, over to you.
Yes. Let me see how to switch here. Oh. Yes, it's a pleasure to be here and to present our joint paper with Jan Klakschow, Rainer Martin, and Jakob Fiedermunz about the central question, why do SMEs not apply for loans? So you see it's still work in progress. We're still shifting around a bit. And if you also look at our affiliation, this feels a bit like a home game. So of course, the standard disclaimer applies. The views expressed here are our own and not the ones of the Slovak National Bank or the Eurosystem. Now, as the title already tells you, we are tackling this topic of bank application behavior of SMEs and specifically the non-application behavior. And already here, let me place some key messages and contributions we want to assess with this paper. First of all, besides the application for a bank loan, we distinguish between different types of non-application and investigate all of them together. So there's, of course, the reliance on internal funds, but also what we try to assess, a belief-driven channel of non-application and a cost-driven channel of non-application. Then in a subsequent expected utility model, we indeed show that not applying for either this belief-driven channel or this cost-driven channel can be the best choice for the SME, based, of course, on these several drivers. In our empirical step, we confirm the literature, what we've already heard before, that larger, older, and healthier firms are more likely to apply for bank loans. And we complement this literature by also investigating the switching behavior from firms that applied in the past to not applying in a recent period because of either this belief-driven or cost-driven channel. And finally, we do a short exercise on the post-COVID period and show that, especially in this period, supply-side stringency is a driver of the switching behavior. But let's come back now and start a bit from scratch. Yesterday, in one of the panels, in the practitioners policy panel, we heard a lot about high-tech, high-risk SMEs. But we have to keep in mind that most of these SMEs are in fact small businesses, family-owned businesses, run by their owners, just doing their business. Nevertheless, they are important for us. They might be hidden champions, they might carry the future stars, and already now they account for around half of the European GDP and approximately 2/3 of jobs created in the private sector. And we already heard in this conference that most SMEs cannot rely on equity, so they have just these two sources, internal fundings or some bank funding. And keeping this in mind, it's striking to see that the vast majority of SMEs reports that they do not even apply for a bank loan. These are around 70% of firms. Now there's already a lot of literature about bank loan applications by SMEs, by firms, showing that smaller and younger firms are less likely to apply for bank loans, also showing that sectoral effects plays a role, showing that profitability, healthiness of the firm plays a role, showing that needs for investment plays a role, showing that also experiences play a role for this application behavior. It's also shown that if a firm applies for a loan and gets rejected, there's this paper of Berg in the Review of Financial Studies, I think it was, they show that a rejection for a loan application has strong real effect on the firms, meaning the firm cuts investment and reduces employment. However, we want to shift this focus a bit to non-application, and there are two papers I want to put a specific focus on. One is already 20 years old, a seminal paper by Conn and Story, where they model this loan application decisions as a trade-off between some expected benefit of this loan and the expected cost associated with this loan. And they formalize why viable, healthy firms might choose to not apply. And there's another quite important paper. I'm happy it is written from my discussant, this paper by Ferrando and Mullier in the Journal of Corporate Finance, where they really show firms are doing this. And in their paper, they also show that especially this discouragement behavior is quite inefficient. As a large share of these firms, 40% would quite easily get a loan. If I recall it correctly, another 40% are still likely to get a loan if they would apply. What we do, how we complement this literature now, we do not only look at one category of non-application. Most literature just treats it as binary, either a firm applies for a loan or does not apply, or focuses on this discouragement. We try to investigate several categories of non-application jointly. And then in the subsequent step, we confirm or we test our proposed channels empirically, and we investigate also shifting behavior. So firms that applied in the past, shifting to non-application. We rely for this purpose on the survey on the access to finance of enterprises. We use the time span from 2014 to the most recent survey rounds in 2025. And I want to elaborate a bit on how we calculate or how we construct our measures of this non-application behavior. Here you see our main survey item of interest. Have you applied for the following types? Bank loans or financing in the past 6 months. And you see answers 1 and 3 are quite straightforward. Either, yes, I have applied, or I did not apply because I have sufficient internal funds. Then there's this answer 2. I did not apply because of a possible rejection, which implies that these firms want to avoid sunk costs. They believe I do not get the loan either way, so I'm not even applying, I'm avoiding the sunk costs with getting this information. What's maybe a bit missing from our perspective here is this notion I believe I will get a loan easily, but after looking at it, I do not apply because these costs and terms are maybe not favorable. This is not specifically asked, which is a bit problematic for our cost channel identification, but we believe that this is inherently included in this "I did not apply for other reasons" category. We then construct our variables from the SAFE survey about the firm size, age, some availability perceptions, whether the financing is used for investment purposes or for refinancing operations, something about past profits. We also consider the panel dimension of the SAFE survey, so we can include the past experience, and we complement this by information from the bank lending survey, where we construct an index capturing the supply side. Let me just very briefly give you a glimpse of the data and the developments. On the left panel, you see the 4 categories of bank loan application behavior over time, where you see a steady decline in bank loan applications. And most notably, in recent years, applying for a bank loan is only the 3rd most common category, already overtaken by this non-application for other reasons. On the right panel, you see the switching behavior, so the share of firms that applied in the past period, but is in the subsequent period shifting to either being discouraged or non-application due to other reasons, where this spike correlates with exactly the period where we had the highest interest rates in Europe. I was a bit puzzled by this spike, but it seems that this is not an artifact in the data, but really a connection to this monetary tightening period. What we then do, we set up first our expected utility framework, propose some mechanism to have some mechanism level investigation in the first step. We complement this by multinomial logit models, where we jointly estimate all potential outcomes. And then in the final step, we conduct some simple logit models for the shifting behaviors. Let's now go into our expected utility framework, where we generally follow the model of Kohn and Story and the hypothesis outlined in Ferrando and Moulier, but we add a bit of this differentiation between different types of non-application. And here I want to invest some time to bring you a bit closer to our way of thinking. If you're an SME, first you want to use your internal funds. That's what also pecking order theory predicts, because this is not associated with some costs. If you do not have enough internal funds, you start thinking about external financing. When you start thinking about it, you might come to the conclusion or to the belief, I don't get a loan either way. It's too hard. Bank loans are not available to me. So you drop out. If you believe bank loans are available, then you start gathering information and think about, okay, how much does it cost? How does it work? This is aligned with the rational inattention hypothesis. But at this step, you might come to the conclusion, no, it's too expensive, too exhaustive. I don't, as an owner manager, I don't have the time to take care of this, so I'm dropping out because of some other reasons. And then, if you come over this step, then you apply for a loan and you've made all these considerations. And in this lower part, this is the final step of our paper where we formalize these mechanisms. This helps us to map our constructed variables to the mechanisms. This is what this table reflects. First, you think about your needs and whether you have enough profits. Then you consider your needs. Then you come to this other cost-related factors. We proxy this a bit by the size and the supply side. And if you decide for an application, you have made all these considerations. What you see here is a combination of linear logit models from where we extract the signs and some LMG relative importance decomposition, which explains how much of the variance explained by the whole model is explained by the single variable. And if we just take two examples, if we look at discouragement, our two variables for the belief, the perception and the outlook availability, explain around 60% of the whole variance explained by this model for discouragement. If we go to an application, the three most important variables by these relative importance weights are size with a positive sign, investment need, and the supply side with a negative sign. So reflecting the cost and the actual availability, supply of a loan, and investment need, a bit this return on investment. Of course, if you want to invest in something, you want to generate some returns. What we can then do is we take the values, we take values for these variables, and we can vary one of the variable incrementally to obtain some ordered expected utility over this incrementally varied variable. I'm just bringing you one example scenario here. We have post-COVID beliefs, so beliefs fixed at the post-COVID sample mean, which is a bit more pessimistic for medium-sized firms, while all other variables are kept at sample mean, and our varied variable is the BLS index, so the supply side. And we see that at some point, the green line marks discouragement, the red line marks application. There's some discouragement margin where being discouraged, believing I don't even get a loan, is in fact the best choice for a medium-sized firm. And if we look at the average, here marked in this vertical red line, if we look at the average post-COVID BLS index, this is not that far from where we've been in the post-COVID period. Now let's come to the empirical investigation, starting with the multinomial logit models, where I just want to take on 4 complementary insights. First of all, and that's a nice confirmation of the literature, and also that we're not hopefully that wrong in the way we're going, bigger and older firms are more likely to apply and less likely to be discouraged, where the latter especially also holds for older firms. This might hint at some experience channel with bank loans already. Second, we see that investment and refinancing need are strongly connected to bank loans. But we see some different behaviors between an application and being discouraged. Both, if you have an investment need and if you have a refinancing need, you're more likely to apply for a bank loan. But when it comes to discouragement, firms that have an investment need are less likely to be discouraged, while firms with a refinancing need are more likely to be discouraged, which sort of makes sense because this can already hint at some firms in trouble. So maybe the firms with a refinancing need are, for reasonable reasons, discouraged. The third message here goes a bit more into our mechanism level investigation. If we look at beliefs, especially the perception, we see that availability beliefs are drivers of discouragement. So weaker beliefs means firms are more likely to be discouraged, but they are not significantly driving this other reasons category. So there is sort of a difference, and for us, maybe a message that these categories really capture 2 different types of non-application behavior, which is also weakly confirmed by the 4th message. If we look at the supply side, the BLS index, this is only significant for this other reasons category. So tighter supply means firms are more likely to not apply for other reasons, where this parameter is especially strong in the post-COVID period, making somehow sense because the COVID period was very special, which we also see in our sample splits, and the pre-COVID period was characterized by basically very, very low interest rates and very available credit. Briefly, the final exercise, our logit results for the shifting behavior. I tried to visualize this graphically here to not present you too many tables. We still see that larger, older, and healthier firms are sort of shielded against moving into this non-application behavior. But the most striking result is really this BLS index, the supply side, which became a strong driver of shifting to both discouragement and this other reason category in the post-COVID pandemic. This result is a bit not contradicting the multinomial logit result, but this result shows a bit, okay, both categories are somewhat related in this regard. Let me wrap up. Summary of results, our reliance, or what we find regarding bank funding and the use of internal funds, is consistent with standard investment theory and standard pecking order theory. We also find that discouragement is mainly driven by behavioral factors and this refinancing needs, whereas these other reasons category is at least more closely linked to costs and supply conditions, with specifically in the post-COVID period, this playing an even heavier role. And regarding the post-COVID environment, we see that this substantially influences SMEs' bank loan application behavior. So what does this mean for policy? Of course, well, preserving favorable, but maybe even more importantly, predictable and transparent lending conditions is key to preventing some inefficient non-application. If this is predictable and transparent, maybe this belief-driven channel is less important and firms really inform themselves about whether I would get a loan or not, and not just do not apply because of some beliefs. We know already from the literature that targeted interventions can help to counteract negative perceptions here. There are some examples of interventions, for example, I think it was in Belgium, to lower the perceived cost of an application and thus to lower the sunk cost. We see from this descriptive statistics, but also from our estimations, that tightening of supply can trigger sharp increases in both non-application channels. And we have to keep this in mind and also further investigate, okay, what has happened in the past period? Has this maybe increased discouragement, or has this maybe changed? Does this cause maybe some persistent discouragement or non-application behavior? And finally, that's I would say, the wrap-up for the whole paper. When we look at SMEs, bank loan application for SMEs, we should not treat application, non-application as binary, but we should really try to disentangle different drivers of this non-application behavior and take a look at these different drivers and the economic forces behind them and shaping them. Thank you for your attention. And now I'm extremely happy for my discussion.
Thank you, Florian. Thank you. Now, we have already heard about Annalisa, who wrote the paper in 2022, published the paper in 2022. Annalisa Ferrando is Senior Lead Economist, Capital Markets and Financial Structure Division in DG Economics at the ECB. Annalisa, over to you.
Yes, thank you very much. Let's see if it works. Yes. Okay, so first of all, I'm very happy to be here, especially to comment this paper, but also for the session, for the first paper. That was quite a surprise for me because I didn't know what it was about. So I really enjoyed this session. Let's start, and of course, thank the organizer for that. So let's start with the paper in a nutshell, very, very quickly. So they look at the survey access to finance. They have 4 outcomes on the behavior of firms related to application on applications. Then they calibrate with this multi-layer approach. They calibrate an expected utility model, and then they check also the relative importance. They estimate this multinomial logic model transition. So a lot of analysis done. And the key findings, depending on the decision of the firms, are this one. So for applicants, firm size investment needs are important, the strongest drivers. For discouragement, instead, there are some kind of behavioral factors, so their expectations, but also their experience on availability of bank loans. Refinancing needs are important. Then we have, for those that say they do not apply because they have enough internal funding, behavioral factors are still important, but also their profitability. And then we have these other reasons that I put in italics because it's in the new version of the paper that I received on Friday evening. So it has changed quite a bit, the perspective of the paper. And here they focus more on these perceived costs. It is in italics because I think it's the one that I don't buy very much, your hypothesis and also the results. But it is important. So there is other reasons that we are not able to understand, or better, there are ways to look at that. But for the authors, these are the reasons are related to perceived cost that are just, say, proxy by age and size and supply conditions, that is this aggregated bank lending survey index. I will come back on this. Then there is the persistence and discouragement. So the self-reinforcing over time is very important. And there are some policy implications. Maybe the most important is this suboptimal loan demand, which may reduce growth and investment. So let's start with the overall impressions. Nice paper, very policy relevant topic. Actually, this idea of discouragement, I think, will be one of the main topics with the next survey round to see what is happening, if we want to look at this. This multi-layered empirical strategy is very good, enjoyable to read, but the challenge lies in the detail. And that is what I want, the details of what I have done. Why? Because why do we care about this? What are the real effects? Well, the paper, I have to say, is not really explicit on this. You say, we know from the literature, we know there on that. But so what I did is I took their data, and I tried to understand, using their classification, what it means in terms of investment and employment. So if you look on the right-hand side of this chart, what I did is I took firms that at time T told me that they were applying for bank loans. They did not apply for the different reasons. And then I looked the survey round after how whether they have increased investment or not. And then you see clearly that depending on what they decided or they have not done, there are different impacts. So firms that applied for bank loans are always telling us that they are increasing their investment over time. You see there is some kind of dynamics, but that is important. While if you look on the other side, you have those that are, did not apply for fear of rejections, that are those that are saying what we are expecting, that are increasing less in investment. The other thing you see here, and I like for that reason that in new version you do pre, post-COVID, etc., because you see that in some cases the dynamics is changing just after COVID, especially for investment, just after COVID, and you see that the categories are closer. So there are some kind of real effects, and maybe it can be highlighted more in the paper. Also in the literature, I will be picking up some papers, because I think this paper has to be positioned better, also to understand better the contribution of the paper. So here I have actually 3 papers that are not in the references, but really are the papers that I think are very important when we speak about discouraged borrowers. One is O'Cowley and Schlip, because here there is really about the dynamics. They are all, these 3 papers are all using the same database, so it's an additional reason why you have to mention or to look at them, let's say. But the results at the end are very similar to what you have. Second paper, one author here. I like very much this paper, if I have never met personally the author, but I like because they use this economic sentiment from the European Commission. So they take something that is a perception of firms, not only firms there in general, but from the European Commission, they check, and then they see that there is a link with the likelihood of discouragement from firms in the survey. Very nice paper. I think you have to need it because it's a bit the channel of the belief. And then there is Aristei and Gori that is not on discouragement, but they have a lot of this state-dependent importance. Last paper, not on SAFE, just came out. That is this Fraser Nguyen, where here what I like is that they have this idea of the dynamic Bayesian learning model. Actually, I can look here. But what it is important here is a bit their pessimistic view. They say that it seems that the firms are not able to learn for the information, and they keep on being discouraged. So again, there are some papers maybe are useful for your, for the paper, what you have done. Comments on the data set, very, very quick. No, sorry, I'm too quick. So one is something that I say always to all the papers. We have 19 countries, but only 12 are present twice a year, 7 once a year. How do you deal with this? It doesn't look that you're looking at this carefully. Survey weights. I've not understood whether you use in your results the weights. This is something that we are very careful. We give it to all the providers of the data. There are some weights that try to restore the proportions of the economic weight of the answer in each size, class, economic, activity, country. So if you want to give a message that is a general message, you need to use the weights. And that is important. So I didn't get whether you were using or not. Comments on econometric approach is very, very quick comment, maybe. Yeah, so in your estimation, you have this dependent variable that is a dummy, then the explanatory variable are a mix of trichotomous variables, continuous variables. I see that when you try the robustness check with the switch to dummies, some of the variables that are important for you lose importance, so you have to be a bit careful. Then the second one is on this linear model to extract the contribution. Why you have not inserted country sector dummy variables? When we use the Shapley decomposition, and we do this for the inflation expectations of firms, we see the country matters, sorry. So we have always this variable in size, and then we see the relative importance of the others. And then this second point, we go back to this. And then the multinomial logic, again, is a bit a free comment, but it seems that sometimes in the paper, you're not able to distinguish between the mechanical interdependence of the outcome, I mean, the dependent variable is equal to 100, from the economic interpretation. That is only a question of drafting. Now, I'm very lucky that the only slide that table that I took from the paper is the only one that I have shown to you. Because I really have not understood how he was choosing the different weights. So let's put it this way. You have seen only a partial version of this. You have seen, I think, you have seen the one that are like the rectangular, the choice of the authors is that. But if you look at the plus, minus, these are the signs of the statistical significant variable when he does the linear regression. And then the arrows more show which are the most relatively important weights. So as you see, and maybe I read too quickly, it doesn't look that there is a direct link between what has been chosen, what comes from the data. So maybe this is just question explanation from your side. Comments on the variable of interest, very quick. Second point, you use financing needs, fixed investment, and refinancing. In the survey, firms are telling us that working capital is very important. It's much more important than refinancing. So I was wondering why you didn't use also the answer of the working capital. Now, and then I will start with the comments, but also suggestion. Past financial performance, you use only profits. No, I would suggest you to use something more elaborated that I'm going to show. Supply side factors, BLS index. Now maybe Miguel is laughing, but I'll say try to avoid to use this index, and I will try to explain why. And then, the last one is just a question of terminology, beliefs, but it's not so important. So let's start with this indicator that you have from the survey. So instead of using only the profit, what it would be nice to have a combination of the information that you get from the firm that is related to turnover, profits, interest expenses, so you have also the cost channel, and debt to total asset ratios. Why do I do this? Because if you look, again, by splitting with your characteristics, the vulnerability is different across groups of firms. Is always, for the discouraged, it is higher. But then you see that there is this dynamic that you were looking that is a bit changing. What it is important is, as we are expecting, that firms that did not apply because of sufficient internal funds, almost by construction, are also the less vulnerable. So I would suggest you to use this. Then supply side index. So let's put it this. It's a combination of different measures people use, but it's not clear. There is no information on the dynamics. We don't understand. The correlations are very low. It's not significant in the determinants of firms' decisions. It's significant in the model to extract contribution, but because it captures the country heterogeneity. It's an indicator of country level. So I was saying why you don't, first of all, why you have not used just the credit standards, so the internal guidelines of firms, of banks, because its advantage is you can split SMEs at large. But why you don't use similar factors directly from the survey? And the advantage is that you will have a firm-level information and more heterogeneity. Okay? So here is just to explain a bit why credit standards are important, how, and credit standard is a blue, how they can link with the survey replies from firms. The dynamics is similar. On the right-hand side, very quickly, because otherwise we have no time, also I show that some selective factors from the bank lending survey that you have chosen are similar to the one from the survey. So this is saying, okay, you have chosen well, but you can do better. And then these are the factors that I'm suggesting you to use in whatever combination you like. But what is important is that they give you the business environment, the firm-specific outlook, the own capital, the credit history. So try to use this information. Then there is another measure, supply side, that comes from the survey that is called willingness of banks to provide credit. It's the bank's attitude to provide credit as seen by the firms. Again, this is because we start in 2014, so this is the easing cycle, so firms are quite positive. But what I think is more interesting is on the right-hand side, the chart on the willingness. So you see the discouraged borrowers are telling us that they think the banks are not willing to provide credit. That comes from your story, so it's another nice way to increase your story. But then you see also the others. I think this is one, before my last slide, that is much more interesting, is about the financing conditions. That is a bit missing from the paper. So here is based always on survey data, but is a principal component analysis. So we pick up one factor, that is the price and terms conditions, that is very important for you. Controlled for the financial position of firms and also non-price terms and conditions like fees, sorry, now a moment, the fees, covenants, etc. Now, why this is important? Well, because we have shown that is following the different phases of monetary policy decisions. But what I like you to show there on the right-hand side is that if you look to those firms that did not apply for other reasons, you cannot see that they are much different from those that applied. So there may be your cost channel that you are thinking of, maybe it doesn't come out from this data. Okay? So just to say, maybe be more careful what you are stating in the paper. Very minor comments, be careful. You are saying that there are not many papers, 22 papers using the SAFE. Well, there are many more, so maybe take away that phrase. And second, maybe don't say that you are the first to do this. Maybe focus instead on the novelty of your empirical approach. And then looking forward to seeing the next iteration. Thank you.
Thank you very much, Annalisa. Lots of food for thought. First reactions by Florian.
Yes, indeed. Thank you very much for this discussion. This is a lot of food for thought, and definitely there are many pieces we will introduce to this paper. Just let me go to 2 points. Or one point, this expected utility modeling. We have a version where we included all variables for in our scenarios. Then I have done a version where I included only the significant ones, and I've included, and finally, in this current version of the paper, we've opted for the ones where we identified the mechanisms purely theoretically, which means the weights and the subsequent significance, they do not necessarily align with this theoretical model, which is why I perceive this empirical part is very important to the paper, to just have another perspective. But sure, this is something where we might need to be a bit more robust in the future, and also with the country and the time fixed effects. Yes, this is something I can do. I believe it will not change too much.
Sector, not time.
Yes, I believe it. We have it in the empirical part. I believe it will not change too much, because when I then exclude these fixed effects and calculate the weights based on what's residual, it should be stay quite stable. But will check it definitely. Thank you very much, and I would like if you could send me the presentation as well.
Of course.
Thanks.
So we have thank you. We have a couple of minutes for questions. Are there any before the lunch? Well, I have maybe a question myself. I found very interesting the last bullet that you had on your slide deck, which was on where you argued that you argued for a targeted approach of policy in seeking to alleviate SMEs' access to loans. Could you delve a little bit into this? What kind of measures might be advisable depending on the reason for non-application? And a little bit linked to that maybe was a thought that came up to me, maybe discouraged SMEs do not apply for a good reason. For instance, that they are not themselves convinced about the return on investment, given, for instance, higher financing costs, higher interest rates, or that they are not themselves convinced of their business model. So discouragement does not automatically mean that the loan should have been given.
Mm-hmm. So maybe on the first point, I mean, we're living in a quite interesting period currently, but there are examples from the literature, in fact, using this Belgium regulation in 2014, which aimed at, it was, as I understood, some memorandum of understanding between the state and the banks, and it lowered the perceived costs for the firm. So it made the information about the credit conditions more available for firms. And thinking in this belief-driven terms, many SMEs, many of these owner managers, they are maybe not finance experts, like most of the people here. And a clearer and easier communication already from the bank side with clear figures, okay, what does it mean for you, might help these firms. And maybe we need to also think about the legislation. We had some panels about consumer protection to make this a bit easier for the firms. That's this point about the targeted interventions. And the second about discouragement. Well, we see firms that need refinancing are more likely to be discouraged. Maybe these are troubled firms, but there is, as we've also seen from the discussion, a large share of firms that would get a loan at good terms and could use this for investments. Sure, maybe it's also on the firm side that they are do not really know what they want, but reporting discouragement, I just believe I get rejected, which is not the case for these firms, is simply inefficient, I would say.
Okay. Okay. Yes, please. Jochen.
Okay, we are close to lunch. This is more a discussion then, because why do you think it should be any intervention by a policy institution? I mean, it's in the bank's interest. If there's surplus left on the table, the first line of defense is the banks go themselves and try. And why should we as central bank or whatever be any better in targeting any intervention than the banks that could do themselves with marketing, with whatever. So that's to me completely unclear. But maybe we can defer this for lunch. It's more appropriate philosophical discussion.
Yeah, thanks for this discussion point. Maybe I would really shift this to the lunch.
Excellent. So with this, I close this session. Thank you very much for the presenters and the discussants. I think you really put some very rich content on the table, both the papers and the discussants. I anticipate this implies also a lot of further work, which is good, scientific progress. So with this, I adjourned for the lunch.
So welcome back after lunch. I know it's hard, but happy that you're here. It's a great pleasure to introduce second keynote speaker, Steven Ongena, but I will keep it short because this is what Steven asked me to do, and I will obey. But this also shows you why he's so much liked in the profession. He has 150 papers, dozens in the top journals, but still all he wants to do is talk about research and none of the other claptrap, so I will obey. Except for yesterday, I heard that there's a certain possibility that a joint project with a colleague from NBS and NBS data might emerge in the future with him, and that would be something that would be really, really cool and I would be looking forward to. But that's it. Let's go, Steven.
Thank you so much. A true honor. So it's a true honor to be here, and I'm going to use the occasion to solicit ideas from you on what to work on in the next couple of years. So I'm going to present 4, maybe 5 different papers. They're sort of all, on average, about 1 draft away from maybe potentially being sent. Having said that, you will see that they're sort of like ideas paper where we try to methodologically, also maybe on the data front, advance a little bit. And so I'm very keen for your ideas. What I'm going to do is first warm it up a little bit, and then I'm going to, paper by paper, go through. I have too many slides, but they're all like more proof of work, right? So you'll see that we've worked on those things. And the other thing is, after each paper, I'm going to pause a little bit, see if there's questions, and then move on to the next paper. So hopefully this will keep you awake after your whatever beef stroganoff that you had. So information asymmetry. It's the, all of our models, banks, bank relationships, banking geography, it's all about information asymmetry. And however, if we think about, as an econometrician, empiricist, about what that does, it creates its issues. And so I would like to invoke the Heisenberg uncertainty principle, which I do not claim to understand, but if you know everything about where a particle is located, we know nothing about the momentum. Conversely, if we know everything about its momentum, we know nothing about where the particle is located. Now, in psychology, this is sort of Hawthorne type of experiments. That I understand a little better in the sense that if you have measurements, you try to measure something in terms of human behavior, the humans are going to start altering their behavior because of the measurement. Now, in banking, I would argue we have something like, okay, so here is this information asymmetry. If we can easily and almost cost-free estimate it as empiricists, why couldn't the bankers do that as well? And so are we sure that we're actually looking in the right place when we're doing our empirical investigations? Okay, so this is a bit sort of the backdrop for the papers I'm going to try to present. So I think information asymmetry is really a challenging setting to explore. But it's therefore also, I think, fun and interesting. And I'm going to therefore present papers on sort of trying to tease out from the data what private information is that the bankers could have collected. And also then a paper on potentially the obfuscation that banks may engage in as a consequence of some other event that I'm going to talk about. Okay. without further ado, so we're going to talk about banks collating information, using information, compartmentalizing information, management information, display, and then maybe at the end, probably time not remaining, I'm also talk about bankers using information. So this is basically the lineup. I'm going to look first at the collection of private information by banks. Then I'm going to see how bankers use information that they then also display that we're going to use. Then we're going to look at within a bank how information is going to flow. And then I'm going to talk about pay transparency to be defined further and how this may actually lead to some sort of obfuscation by banks. And maybe then also the bankers in those banks, I'm going to provide some empirical exercises. The first paper is on trying to see whether or not we can tease out from data what the banks are actually having in terms of private information. And so this is with Stein, who's at Yale, and Teng Wang, who just moved to University of Texas. He was at the board before. This plays a role. Now, what we're going to do is we're going to try to quantify the nature, formation, and implication of private information embedded in banks' evaluation of borrowers. And we're going to use Y14Q, which many of you know is sort of the US credit register. It has limitations in that it has a hurdle and it has a frequency which is lower than AnaCredit, and the hurdle is higher. And we're going to basically try to tease out what this private information is that they may have, and then what does that have for implications, and how does this collection of private information develop over time. So we're going to come up with some very simplistic measures about what this private information is in terms of debt, positivity, and negativity. I'll define that in a second. And then we see how it forms over time. And so we're really trying to do something on the learning. And then what is the implication? I'm going to front load that a little bit. I'm going to show you lending outcomes that are the consequence of this debt positivity and negativity, and then show you how this information is being formed over time. Now, underlying is a heteroscedastic regression model. It's not truly, I mean, we do it two-step, but in a heteroscedastic regression model, you're going to try to model what the mean is, and then you're going to have a variance equation. You're going to have some dispersion. I'll show you a graph in a second. And this is where the paper turns on, okay? So this is sort of explaining the two elements, two main ingredients in this investigation. One is that you're going to have, so here on the horizontal axis there's distance, on the vertical axis there's the rating. So it's the rating, think about the PD, but this is the rating that the banks are giving. By the way, this is also by the Fed sort of transformed into something that is then potentially homogeneous across the banks. There's issues there, but so this is the rating from best to worst. And then you see here the banks B2, that's bank 2, rating firm 5, okay? And so what we're going to do is we're going to have all of these ratings, and we're going to explain these ratings with, say, the mean equation. And that mean equation is going to be here, that linear schedule. Now, one of the main pieces of intuition that you need in a heteroscedastic model is actually that when you start modeling how factors may influence the dispersion, actually the exact position of this linear schedule is actually somewhat secondary. This is the uncorrelatedness of the betas that you have in the mean equation and the gamma in the dispersion equation, the variance equation. And the intuition is that if you try to explain where you are in terms of dispersion or deviation from this linear schedule, the exact location of that linear schedule is actually not all that relevant. So how the differential factors drive this. That's one piece of intuition. The other piece of intuition, and there's a bit of a tension there, the other piece of intuition is that, of course, if you're going to now use a firm time fixed effect, what you're going to do is basically you're going to argue that on average the banks have it right. And that may not be correct. And the schedule here is an illustration of this. So we have B1, which is located quite far from this firm 5. We have B2, and we have B3. All of three of these banks are going to have private information that is more than positive, like compared to the linear schedule that we shoot through all of these observations that we have. Now, clearly, when you now put a firm time fixed effect through this, what you're going to do is you're going to have that schedule now suddenly sitting somewhere between these 3 points. And so, to some extent, then you impose the assumption that the banks, on average, have it already right. And that may not be true, because they may all be learning about this firm, and they may all be, I said better than average, I meant worse than average. They all have a worse rating, okay? So this is the tension in this paper, and it's sort of an interesting tension, and something that clearly warrants further investigation. And this is where the empirical investigation is then about, is sort of what determines this private information that they have, allowing for the possibility that they all would be more negative or more positive than average, and how is this related to time and to distance. And so we use this Y14Q, and then we have as main variables, so it's a bit correlative, distance, length of relationship, and then we have other characteristics, firm characteristics, bank data. And so this is then the first stage. To some extent, this is important, but it's not the main issue in the sense of this uncorrelatedness between these 2 levels of analysis. And then basically you see there that indeed ratings are reasonably explained by this characteristic that we mobilize, both at the firm level and at the bank level, and then at the distance between the 2. So this is not really a result of the paper. Here we have the first set of results. So basically what we're going to do is we're going to have 3 outcome variables in terms of dispersion, if we want. We're going to have dispersion pure, which we're going to call depth of private information, which is the residual squared logged that we take from the first stage, right? So that's heteroscedastic modeling. So you take the residual from the first stage, you square it, and then you take the log, and that is then basically this depth of private information. And then we have the residual being negative, that would be better private information. Residual being positive, that would be worse private information. And then you can start explaining this, and then you will see that indeed, if your firms are located afar, on average, they're going to get a worse private information by these banks. Now, having defined these measures, that positivity and negativity, then we find ourselves asking, is this actually reflected in the loan terms? And yes, it is. So debt and negativity information increase the rate, and lower maturity, positive information, is going to decrease the rate and increase maturity. So this is comforting. This tells us that, after running this first stage, we are somehow ballpark in terms of how relevant then these characteristics are, or these outcomes are, for the loan terms that are being granted by these banks. So uncertainty about the borrower's quality lead to a higher risk premium and rationing. Good. Then the rest of the paper is basically a development on how this private information, and again, this is a first pass trying to see whether or not we can learn something from these ratings in that context, whether or not we can provide more meaning to this formation of private information. And we can see basically that the depth of private information is increasing in the length of the firm-bank relationship, and also that over time you actually get more and more better private information and less worse private information, okay? You can imagine that maybe some of the really bad firms by then are left because the banks does no longer want to engage them. And then basically, once having established some of these elements, we then are interested in how geographic distance is now going to interplay with this formation with this relationship in terms of the formation of private information. And so basically, as the relationship lengthens, we're going to have more and more private information collected for distant borrowers. And then we produce a bunch of fancy graphs, but it's always economically relevant with the points that I make here, but we're going to see that the firms located far away are disadvantaged in the beginning, and then the bank learn mostly positive information over time. This is how this developed. This is what these slopes are indicated. And then in terms of bank characteristics, actually we find that smaller banks are more engaged in private information collection, at least the way we try to measure it. And then also the firm size. Here, very interestingly, we find that actually we're going to have more positive information collected for larger private firms. So size here actually is a somewhat surprising element. But remember, they're all private firms. So we took out the publicly listed firms. We do all the exercises with as well. It doesn't matter because there's only few of them. Of course, they get a bit more credit. But so there's more positive information collected for larger firms over time. So you start off maybe a bit negative, and then you get more positive as you engage this firm over time. And then we see that during COVID, a smaller amount of private information was collected, and especially worse private information was collected. So this is very tentative conclusion. It's the first attempt at trying to tease out sort of private information from these ratings. I think very similar discussions can be held in Europe about using these PDs and seeing what the banks are actually fessing up there in terms of what they know more compared to their peers about a certain client. And we see that these measures, at least, and they're very simplistic. One can do much better stuff, and I think we're all sort of acknowledging that this is a first pass, and much more can be done within this context. The banks at least adjust their loan terms accordingly, so it's all fairly reasonable, and then we visualize this process, and we see that indeed over time more information is collected, and distance is sort of an initial barrier, is an informational barrier that they have to jump over. Are there any questions on this? Otherwise, I keep on droning around on the next paper. Everybody's cool on this? We can also have conversations afterwards.
Okay, let me ask one.
Yeah, good.
Because distance, of course, also the initial decision is endogenous. So is it that this is upward sloping, indicating that the banks in expectation thinks the further away the firm is, the more positive news it will get? Or is, how do I think about it?
Surely there's an engagement probability that we don't monitor. That we don't model, sorry. So this is something, I mean, we could have a first stage where we model whether or not you're engaging a client, because we know where all the clients are more or less located in that credit register. So that is a good thing that we could do. We could first do that and then see whether or not, in terms of selection, it would matter for the outcomes. We have not done that. Yes. So that would be a first stage of two other stages. Now, clearly, within the confines, so we could do this in a one-step heteroscedastic model. We haven't done this because these positivity and negativity measures are not so easily done. This Heckman or this sort of selection would not necessarily be possible within a heteroscedastic model. So you would have to do it first one stage and then bring that into a heteroscedastic model. But surely that's something to be done. Yeah. Anything? Yes.
That the bad firms drop out and only the good ones stay. Now, I want to know your opinion about two other explanations. One would be that over time, the banks need to be less cautious in terms of a risk premium for lack of knowledge because they increasingly know more. Yeah. Or the alternative, more behavioral economics explanation, that as the customer relationship becomes longer and deeper, that might create some kind of loyalty on the side of the bank customer account manager, so sort of bonding that he hesitates to, be too strict or whatever.
Yeah, I like both suggestions. I mean, on the second one, I'm not sure that the data is there to nail this. I would have to check. I don't think there's a manager identity stamp on any of these transactions that are taking place. But of course, we could allocate. I mean, I don't know. Let me not speculate. But so I like the idea. Yes, and on the other, the other possibility clearly that could also be. I mean, there we could maybe do something on the. There we could do something on the. sort of how well capitalized the bank is, or what it would cost, or also the relative size of the loan, and sort of absolutely we could definitely play with that and see whether or not that would change a bit the dynamics of the way this is reflected into this private information. I mean, I take it that our interpretation is that this is really reflecting purely what this set of information is tentative. I mean, of course, there may be things that are polluting this also vis-a-vis the, as you said, vis-a-vis the supervisor, regulator, etc. So that is another, I think, very interesting domain of investigation, is like how do these PDs, especially when they're generated by some of these models, are to some extent responding to pressures from outside. And I think this methodology can definitely make a few additional steps on this account. Yes, and by the way, on the selection, I take it that this is something that we should add. Having said that, with these heteroscedastic models, so when we play with the mean equation in this context, but also in other contexts that we've used them, typically omitted variables play a very minor role. So even if there would be a selection, that could still be a very meaningful variable in the mean equation, but when it comes to sort of the factors that are then driving the dispersion, it may still be secondary. So having said that, of course, it would be very interesting to see whether or not there is a selection into engaging clients further away. So, okay, the second paper is with Qiang Li. She's a macroeconomist, associate professor at Leipzig and also in Hull at the Research Institute there. And it's really trying to blend a little bit this global or this macroeconomic expectation literature with credit supply, bank credit supply. And so it's a very simplistic paper in the sense that what we're trying to see is what the expressed expectations is by banks, how this is potentially reflected in their lending in the syndicated loan market. And so we're going to say something about global banks' macroeconomic expectation and their impact. And so how does this affect their credit supply? And I use the word credit supply because we're going to look within loan of a syndicate loan. And so we're going to have these characteristics of lenders' information process for macroeconomic expectations. There's a part of the paper on this. I'm not going to dwell on this. And then the impact on their lending. And so these are the two, this is the research question. Now, data is an issue, and this is sort of where I wanted to highlight this paper because we discovered this part of expectations by banks on both GDP and on inflation, and then how this is affecting their lending. So we're going to use consensus economics, which basically allows us at the institutional level to get lender month macroeconomic expectations, so GDP and inflation. And then we match all this with deal scan and bank focus, and we're going to look within loan. Now we have a small IV setup as well. I'll talk about that in a second. So what we find is that basically, first of all, we look a little bit at how banks are forming their information, and so we want to benchmark that to the rest of this expectation literature to see whether or not they're regular agents or they're somewhat odd. They're regular agents. So to this extent, they're very comparable to other agents that deliver these expectations. And then these expectations that they generate themselves seem to matter. So for example, a GDP expectation increasing by 1 standard deviation increases their lending share by up to 8.5 percentage points. And so remember, in a syndicate loan, you have maybe 10, 20 banks participating. So the shares there often are order of magnitude 5, 7%. So this is a very sizable increase in the share that they would take in an individual loan. And then that effect is going to be more pronounced in borrower country currency and with optimistic news. So they're really going to lend more when the GDP that they think is going to be materializing in 12 and 24 months is higher than the other banks. Then they take a much higher share. While negative news is somewhat muted in its effect. And then inflation expectations show an insignificant impact. And that is something that we still somewhat interested in, and we don't understand why, literally. So this is a very large, of course, related literature on expectations swing by this. So we use this consensus economics. So because there are 400 forecasters, and 200 of those are banks, and many of those are international banks, and they're going to be active in the syndicate loan market. And so basically, we're going to use their expectations as they record them in this database. And so there's going to be these commercial banks, and we have these individual forecasts at the monthly rate of GDP growth rate and inflation in the current and the next year, so 12 and 24 months ahead, and they're going to actually make 24 forecasts starting in the January of each year. And so, we're going to remove some sort of outliers, if you want, where there's really odd forecasts that we think are misrecordings. And the banks are going to deviate from each other. This is just a few examples. Germany, GDP, Deutsche Bank of America, and then the consensus forecast that is generated. And there's the disagreement, but this is very well known in the literature, is also, of course, diminishing with forecasting horizon. And again, on this account, the banks are not all that different from other forecasters. Then we have syndicate loans. Many of you know what this database is about. We're going to use both the actual shares that we observe and sort of imputed shares, as in the Haas van Horen. Results are unaffected. And then we're going to match this with these lender names that are coming from this consensus economics database. And so we have about 10,000 deals to work with different tranches, 70 banks, and then borrowers headquarters in 17 countries. And so these are summary statistics. This is really the setup. So we're going to have HSBC and UBS giving a loan to PepsiCo. PepsiCo US, so they're active in the US market with a syndicate loan. And we're going to have GDP expectation for HSBC 2.5, UBS 2.3. And then we're going to study their loan share, basically, within loan. Okay, so this is the only thing we do. And so then we characterize these global banks' expectation. There's sort of there's some consistency there. There's some rigidity there. It's for GDP, not for inflation. Let me pass by this. This is sort of illustrating then that for banks, this looks very similar, at least in this characteristic, in terms of this information constancy, if you want, with consulting, with MBFIs, with universities also. They all look very similar, which is comforting for us, because then otherwise this bank could have done a very different type of job when it comes to forecasting. It doesn't seem to be that case. On inflation, you can see that, again, it's a bit less, it's a bit more all over the place, but the banks are, again, not all that different. So then the baseline specification is about this lender share. So we have basically the lender share, and we have then this expectation. So we have this individual bank's expectation, and then we have characteristics of the bank, and then we have loan characteristics, but we also, I think the main specification is really this within loan. Okay, you can also do within borrower time, but within loan is super clean. I mean, you really have to come up with a good story. It's not impossible for why that wouldn't suppress credit demand, right? So you really look at the relative shares within these loans, and then you can model this. Now, the main result then is indeed, sorry, that was a bit too quick. Up on top there, you basically, if you have a higher growth expectation when it comes to GDP, you're going to take a higher share. And so one standard deviation bank growth here increases the share by 4 percentage points. Okay? Now then, we do a lot of stuff. I mean, we check whether or not this is all consistent and constant across the various specifications. So we have this Osterbound testing to see whether or not we're missing something. That doesn't seem to be the case. And then we do a small IV. So, I mean, the IV here is something that I would love to have comments on for improvement. What we do is we do a bit something like a GMM-like, but it's actually more nifty than a GMM, because what we do is we use a forecast from the bank that it issued in a prior time. And so then we have basically the bank issues the forecast. We use that as an instrument for the forecast 12 months later. And so to this extent, during that time, something happens. Presumably, that's the assumption that the bank didn't influence. Of course, you could say, yeah, but this bank gave so much credit to this country that the GDP growth forecast or the GDP growth during that time period was so good, and also and the forecast was so good. So there is a bit sort of something that we are still thinking about, and this is the best we came up with. So it's a bit more than GMM. It's more than just taking some T-1. But you could still worry about this. And then again, the baseline results, the IV estimates are only 2 times as large, so that's not so bad. And so the inflation factor is there good, and so we have a loan share increase by 8 percentage points. And then we see that this effect is stronger in the currency of the borrower, and then there's nothing there for inflation, which is also something that I would love to have inputs on what to look more for, and that's it. Second pause. Over to you. If not, then I continue. It's almost like the teacher say, and then I continue. Yeah. No, but then I collect some comments after all it's all said and done. Okay, the third paper. So the third paper is on the way in which information potentially flows or doesn't flow within a bank. And the setting is a large Chinese bank, and it's with former student Xu Sen Kui, who's now at Xiamen and also at Peking University, and then other co-authors of him and mine. And it's on basically trying to see within a bank how there are also information frictions between branches. And so we are going to look at one bank where it's a large bank, and so with a lot of branches and a lot of loans. And we're going to study the conditions that borrowers are getting when they switch branch. So not bank, they switch this within the same bank, they switch branch. And then we see what they get. And of course, we're going to be interested in interest rate, but also in other characteristics, other loan terms. And so, I mean, some of you may also know of this sort of small niche in the literature where people look at basically the discounts that borrowers get when they switch bank. And so we have this paper with Vaso, Ioannidou, where we basically see that these firms that go to a new bank, they get like 18, 19 basis points lower loan rate. Okay? And this has been replicated for Portugal, Italy, Germany, a number of other countries. This was for Bolivia, always in the same order of magnitude. So this is for firms that are switching banks. Now, with Diana and Gilles, we then also looked at when your branch is closed and you end up being an orphan and you have to go to another bank because there's no more branch of the bank that you're dealing with in the vicinity, you go to another bank, do you then also get the discount? And the result in that paper is that you don't get anything. So we call these guys or girls transfers. They're transferring to another bank. Now here what we do is we basically, and then Tony with co-authors has this paper on when the bank branch is closing and all these borrowers are swept to another branch of the same bank, what is happening then? And they even find that there's almost like a higher, if anything, there's a higher interest rate for these. So that for sure they don't get a discount. And also there's no for this type of transfer, within bank transfer. And so this is basically what we're after. Now, why is this an interesting cell to look at? Because it is an interesting cell to look at because it tells us something about how potentially information flows within a bank. Because the interpretation here was always that you go to another bank, there's this informational friction, and that therefore you need to offer a discount because, and then over time, of course, the finding is that the interest rates get increase, right? So you start extracting then. There's this rent extraction. So initially you have to give this discount is representative of how big this informational friction is. This for the Bolivia paper. And so for China then we do, for this Chinese bank we do then this whole exercise. And the exercise exists mainly in exact course and matching, where you have to try to be careful about your matching strategy and then the estimation that you do. And that's the result then. And so then you can match with basically inside bank, or in this case, inside branch loans and outside branch loans, all right? And so that is a bit sort of the whole spiel in that set of papers, that you need to do this then in a way that you sort of, then you can also make you can also then interpret these spreads or these discounts that you generate. And this is then matching on inside branch, matching on outside branch, and we sort of go through the same motions as we do in the rest of these papers and others have done. And then the finding is indeed that you're going to have a discount. So this is the matching model, then you have the regression, and then you find that basically here are the spreads. So you find about 5 to 10 basis points when you're a switcher, you go from one branch of the same bank to another one. Okay, so that is basically the starting result. And then we have more spiel on this, because then we say, okay, what if now a new branch is being established? And you could imagine that that new branch is actually less in the loop than the branches that were there before, and that's exactly what we find. So if you are switching to a new branch, there's going to be a steeper discount. And then we also investigate the dynamics. So just like in these other papers, we look at the dynamics, and this is in months. So you get first a discount, you get a little more, and then bam, you start paying more. And for the new branches, you get a steeper trough, and then the interest rates starts increasing significantly. Then you look at other loan terms. Then in the bank, there was a definite moment when fintech was being introduced. And you could imagine that the introduction of fintech leads to different informational flows and frictions. And so what we then do is we try to estimate this, best of our ability, to see what the effect is. And we do find sort of a reverse U-shape. So what we do find is that initially, indeed, that fintech leads to an erosion of this discount that you would get if you switch from one branch to the next. And so there is that fintech seems to alleviate these informational frictions that occur, but it's an inverse U-shape. And then we actually do see that at some point that discount starts to worsen again. And of course, one interpretation is sort of like Hauswald-Marquez-like, which is that surely this fintech initially could have been deployed to sort of ease informational frictions within the bank, but then at some point, individual agents, loan officers start engaging again in a strategy whereby they actually use this fintech to know more about their customers, but then they also start to hold that information in their private little domain. And so they have more information, but they share it less. So this is sort of this Wilhelm and another type of models that is then the case. And then we also run a survey among bank employees, because we were interested in these results. I mean, how can it be that if you go to another bank, you get a discount, and why wouldn't the bank hold these kind of practices? Is this really true? And so we then run a small survey to the best that we could in this bank, and we do find indeed that they are competing. So these branch managers, they fess up, yeah, surely we compete for clients, and we have difficulties sharing this information, especially soft information. So this is all consistent, so to speak, with a lot of the material out there in the literature, and also with the findings. And then the application of fintech, also there we have some survey questions that are consistent. So it's really, we try to, within the confines of this data, see whether or not there are informational frictions within the bank, and seemingly there are, and fintech, new branches seem to suffer from this more. They are not yet in the loop, and then fintech alleviates it, at least initially, but then at some point, this gets reversed. Are there any questions on this? Yeah, thank you. Go ahead. Yeah. Oh.
Thank you very much. I mean, just out of curiosity, what do you think how much this last point that this information sharing within the branch of the same bank is not like 100%, especially this soft. So it means for me, or does it mean then that the price formation is not just based on like set in stone rules, so they have some flexibility in setting loan pricing? And to what extent can it be like generalized? So you have one bank in China, so if you expect this to be the case also in other like huge banks, like UniCredit, whatever.
Yes, that's a great question on the, to some extent, asymmetry of loan pricing, because we often suspect, and we know from sort of casual observation, that loan officers often have a lot of discretion upward, but not so much discretion downward, right? Now here we're talking not about 100 basis points, we're talking about a couple of basis points, so we think that this is still reasonable. Having said that, maybe we could once see whether or not, I mean, so one thing we could do is per branch, see what the past discretion was, because that could be somewhat indicative of locally, like the informal and maybe formal rules that the loan officers are under, and then like highlight especially those branches where there's more discretion, because then I would suspect actually we would see an even bigger effect. But you're absolutely right, so there is this clearly, I mean, we know that branch officers, loan officers do have discretion over loan term setting, right? I mean, but mostly upward, maybe somewhat less downward. That's for sure. There's always a floor. Then on the second thing, surely external validity, absolutely. It's a very large bank though, and China is a large country. You know, other than that, I would love to investigate this also for Europe. I think, as far as I know, in UniCredit, we don't have actually allocation at the branch level. We typically use the closest branch assumption. And so on this account, you cannot do this with UniCredit, right? But maybe there's other one bank data sets where this could be done. But thank you, it's a fair comment.
And how do you explain the downward? That it goes down, the U shape, because initially, like, if I understood right, you would expect sort of an increase. The customer comes, he's there, and then I start increasing. But why is it going down further?
We show that. Yes,
initially it's going down, right?
Yes.
And why? What's the story for?
Why it goes down further? That's a fair comment. It's something that we see in Bolivia as well. And so it could be that there's already some sort of implicit, it's a fair comment, yeah. So typically these loans follow, I mean, one thing, it's something really that we never dug into too much. But one thing you could imagine is that this effect would be even stronger if the loan follows very quickly, while if you take then a loan half a year later, you're already on your way up. Yeah, I can write this down because it's also there in the Bolivia data set, our interpretation, and also in the Portuguese and the other work. Our interpretation was always that it's sort of like a bit part of this initial step that you make, and maybe you get a number of different loans, but again, this was never further investigated, so we should actually look at that.
Grab the microphone, Florian. Oh, right now.
Oh, sorry. Oh, all right. But,
go.
So just two very general comments or questions on this. First one is on the role of banking supervision in all of this, because if you think of the Basel II, Basel III, I mean, one of the key ideas behind it was exactly to reduce the discretion that loan officers would have and to replace it with hard data to make this more objective. So do you think that if you look at this over a sufficiently long period of time, maybe the implementation of Basel II or even more Basel III may be some sort of structural break in your series? Because you, as a bank, you will depend on different forms of data over time. And the second point, a bit related to this, is how does data protection come into this? Does that in any way, because that's, of course, the strictness of that is very different across countries and also over time, it became much more strict. So is this something that has an impact on the amount of information that the banks can get? And also maybe on sharing information within groups or between groups? I know very general, but
Yeah,
may play a role.
So for Basel, of course, this affects the whole bank to some extent equally. It's a fair comment. I think we looked for different time periods within. The results were very similar, but of course the time period is also not that long. In terms of information, clearly China is a bit of a different place than Europe when it comes to the care about individual privacy. I'm now working on another Chinese bank data set, and it's literally, the amount of information you get about the borrowers. There's all these social control variables now. Are you a good communist? Are you a good community member? It's amazing. Yeah? So it's so to this extent, I think on this account, if anything, they went the other direction, if I understand this correctly. But it's something we should actually think about more, also in jointly with this other project that I have with this Chinese other bank. Yes, was there another? Yes.
Yes, a more speculative question. You mentioned all these soft factors. Is the finding you have, is it really an effect between the bank branches, or is it even more on a personal level, so individual for the direct contact?
That's a great question. So on this account, the data is not, at least that we have access to, is there to have a loan officer identity. I have another paper, not to plug that one, but with Christoph Herpfer and Marcus Ceccarelli, where we look in the syndicate loan market, and there we actually have individualized loan officer participation in this, and then we couch it in a gender context. There you can see basically these kind of issues about loan officers moving, and because you could imagine that here it could be a branch officer moving, right? So a loan officer moving. We don't have that. So yeah. So that, I would think that this could potentially, but again, this is speculation, this could be making our results conservative, because if you take as a loan officer your clients with you, why would you start offering them discounts? But again, maybe the inconvenience of going to another branch. It would be super interesting, yeah? So, but we are a bit stuck there on this account. So we have the branch identity, but not loan officer identity. But it's a super good comments. Because I do believe that loan officers individually play a very important role in sort of how this runs. Yes. Now we have a lot of questions. It's good.
It's a very interesting paper. So just a comment on the Chinese banks. So you mentioned, so your data is from one of the very big Chinese banks.
Correct.
I assume this is one of the big four.
Possibly.
Yeah, and because it's very big, that means it must be one of the big four. So I think, given that China is very big, and their business in the northern part and the southern part, their client base are different. So therefore, your bank, specific one bank, from which part? If from the northern part, they are more likely their main client are SOEs. And if they are in the southern part of China, they are more like, the proportion of private clients may be more. So therefore, when you draw the conclusions, need to be just careful, because given the very big, it's not homogeneous. So even within the bank, it's different.
No, that's a very good comment. This is the average effect, right? So, but I take from your comment that we actually should explore further the heterogeneity. One thing I didn't stress actually is like we use this matching scheme, and then we end up with a regression anyway, because we want to see the loading on the constant, the average effect, but we want to do the clustering correctly and what have you not. So clearly, when you do that matching, then you can tack on like variables, like you could tack on like characteristics of the firm, we could do like some geographical differentiation, and absolutely. So I think this is something that we could do, we haven't done, because we never saw a very strong reason, but this could be a reason in terms of the differentiation, in terms of clients across the geography. I'll pass this on to the co-authors, and maybe we can come up with something also interesting on this account, because their characteristics may also drive the informational friction, right? So.
Yeah, exactly, because I used to work for the ICBC, the largest bank in China, so for 10 years. So I know. So when I visit some of the banks in the southern part, so and their business is
very
different from I'm from the north. So
no.
why, so this is
I know some of the geographical emotions in China very well. So I have 11 more minutes, and I was told I was going to be kicked out if I go 1 second over time. So the fourth paper is on pay transparency, and this is for the US, and it's with Piotr, who's at Tilburg. And so it's about basically how does pay transparency, to be defined in a second, affect employment conditions and the granting of credit by bank loan officers, and how does it affect the opacity of the bank itself? That is the question we try to go after in this paper, and it's about this pay transparency, which is a state level or city level ordinance in the US that basically imposes on all the economic agents, when they try to hire, they also need to reveal what the pay range is that they're going to offer. There's a huge literature in labor that we take as a source of inspiration on the importance of this pay transparency. And so typically what they find is that it increases the wages, and it basically makes searching, it persuades people to search. Now, in our context, what we're going to find is we're going to find that indeed, when there is a pay transparency in the state compared to the other states where this pay transparency is not in place yet, we're going to have more advertisements with pay ranges. We're going to have higher wages, and we have more mobility. And we're going to be very interested in how banks versus non-banks, how that works out. And so then the question is, does pay transparency and does pay matter in banking? And surely this can matter for the quality of bank assets. There's nice published work on this. It can have positive effects, it can motivate, but it can also have negative effects, in the sense that if you know that somebody earns more than you, maybe your morale is affected, and maybe you have incentives to generate higher returns. And so the paper is really about then whether or not this matters for banks. And then we also now investigate whether or not this affects the bank opacity. And here, I have to say, I find it's a super interesting topic, because there are prominent models in the literature that argue that banks may obfuscate. And they may obfuscate because they want to safeguard asset values, thereby their liquidity. And of course, there's also potentially agency issue within the bank that the managers may obfuscate versus shareholders. And so what we find is indeed this pay transparency leads to lower credit quality and a higher opacity of the bank, and so of the banks. And this is always comparing banks to banks in areas that are not affected, but we also have parts of the analysis on the non-banks, because the non-banks here play an important role, as I'll show you some numbers on this. So these are the pay transparency policies. So this is going to be a staggered diff and diff. These are the policies. And then we're going to estimate this diff and diff. We have advert data, which we bought. We have employee and bank level data, which we take from the public domain. Now, one thing which I did not know is that banks, for the same job, for loan officers, exactly the same job, pay on average $81,000 in the US, while non-banks are paying almost $15,000 more. And the job description is the same. Of course, maybe the skills differ a little bit. Maybe the ones in the non-banks are slightly more skilled with computers. We don't know. But at least for the survey purposes, they're the same jobs. And there are literally hundreds of these jobs defined in this American Community Survey. So at that level, at least, of precision, they're paid substantially more in non-banks. And then basically the paper unfolds in the following way. We're going to have this pay transparency law being passed, which, by the way, these pay transparency laws were motivated also by the gender gap. Right? So, and then it actually works. And this is in the labor, in labor literature, they show that indeed the gender gap is closing, pay gap is closing as a consequence of this transparency law. So the reason for this introduction of these laws also has nothing to do with financial institutions, right? I mean, it's really across the economy. And then, so basically, then we show that pay is revealed in relatively more adverts. We have this advert database, and then also for loan officers. So we can also show that. And then we show that actually experienced loan officers start to leave non-banks that pay more. We cannot actually trace the individual employee leaving, but we can see that there is an out on the banks and there is an in on the non-banks. And then we see that the banks actually want to hire new loan officers and they're going to place more adverts. We can also see that. And then we have the increase of the wages at the banks. We have two different data sources where we can corroborate this in terms of wages observed at the individual level, but also at the bank balance sheet level, basically. And then we also see that the banks are going to hire new loan officers, and then we do a twist on an exercise where we can, which is suggestive that they're actually hiring loan officers with expertise, lacking expertise. Then we see that loan quality slips and that loan losses are going to mount. Okay? And then basically we see that banks are going to start managing loan loss provisions more, using sort of off-the-shelf accounting literature measures, and so basically then we see opacity generate. So to some extent, you squeeze the balloon on one end by imposing more transparency, and then you have more opacity in terms of the way in which they go then through their credit business. I have a lot of proof of work slides here. We do all these sort of different staggered different diffs and at the various levels. Let me sort of go to my final slide about sort of possible issues of further investigation. So really pass by this paper. I also had a paper with Iranian data to talk about what bankers do in Iran when they know something more about the inflation's expectations and how that is reflected in their taking of credit. But let me go to the final slide, which is like the potential interesting margins to push research. So something that somebody asked me over lunch, what are you thinking about? Well, this is what I think about. So maybe non-banks, fintech, and banks, I think is super interesting. I mean, we now see clearly in the US a major bankruptcy, First Brands. This was exposed to non-banks. And clearly, how are their differential use of information processing? Then I think also AI, right? So the way in which AI is going to complement, substitute loan officer expertise, I find that a super interesting topic. I mean, of course, how AI is going to replace us is also very interesting in the sense that, I mean, the last couple of months have been a bit of an eye-opener for me in terms of a number of research teams that we're now really pushing use of AI very hard, and I think it's amazing what it can do. How information internally by loan officers is collected, maybe a bit pedestrian, maybe, but linked to the first paper, because I do believe that there's still a lot more information can be wrung out of these PDs that we observe, also in AnaCredit, and how those are sort of different across banks, across time. And then clearly also social media, and I think there, obviously, colleagues have already pushed that frontier very nicely in terms of using social media information, also in credit granting processes. And that's it. I have, that's 3 more minutes.
One more paper, no?
Yeah, no. No, wait, maybe questions about, oh, no, it's, yeah. Questions about the final paper, the 4th paper, maybe. Pay transparency. Anybody pay transparency? Pay transparency once. Twice.
I mean, the obvious one for a macro labor guy would be, why was the initial allocation as it was? Given that, why didn't the experienced loan officers already go to the non-bank guys, given that they earn so much more there? And why didn't they try to attract them? That sort of, to me, seems the initial inefficiency, which seems a little bit weird.
Yeah, I mean, so my speculation, but we cannot see that in the data, clearly that even though they are loan officers, maybe they're still slightly differentiated in terms of their ability to handle, you know, PCs and informations, you know, because we know that these non-banks are often, not always, but often are more transactional, more information-based. And so despite the same title, maybe there would still be some frictions in the sense that if I'm a 50-year-old loan officer, it's not clear that I'm going to end up with a non-bank that easily if I don't have the skills. And clearly these non-banks also in there. So this is something that one could do, is like look over time a little bit how these non-banks, because they have been growing, but also not homogeneously within the US, and how that is then reflected in the pay gap between the two, that one can do. And the other thing that we're currently working on is seeing whether or not these non-banks then are, how their health, so their financial performance is developing as a consequence of this pay transparency. But there the data is much harder to get, so I'm not sure. I would be curious to know. Because publicly, on non-banks is close to impossible. But
the question is whether the non-banks have different risk characteristics from the point of view of the employed. So are these less reliable employers, maybe? And the other thing is maybe the overall salary is bigger, but it's also a question how the salary is composed, how much is performance linked, and therefore induces more pressure.
Perfect. So on variable and fixed pay, the data is not available for that across these. But I agree with you. So some of these non-banks, clearly also in the beginning, they may have been more risky. So there could have been a risk premium for these loan officers. Yes, absolutely. No, but so this is something that we're trying to go after, but I'm afraid we're going to get stuck quickly because the data is simply not there yet. Maybe now it is the faults that are occurring in that space. Maybe there's going to be more efforts to collect also data on them, so to speak, because clearly some of the banks are also exposed, you know, the usual story.
Okay. Steven, thank you very much. 4 in 1. That was a very good deal for us. And let's give him a hand.
Okay. I think we can start. Good. When we have more people coming in, that's still fine. Good afternoon, ladies and gentlemen. My name is Julian Toth, and I am from the International Sustainable Finance Center. I'm really glad to be here and to chair this section on green financial policy. Some of you could argue this is the most important section. Some of you could say it's best for the end. I do work for International Sustainable Finance Center. I may be a little bit biased, but I'm really glad that there is a section on green topics or sustainability and climate, because many of you may know, working on these topics, there has been certain backlash on some of the climate and sustainability topics, not only in the financial sector, but also in business overall, across different sectors and markets globally. And as you know, obviously in the EU as well, we had the omnibus package, and it's quite interesting for me as actually working in the middle of these topics, based in Czechia, working with banks, insurance companies, investment funds, as a think tank. It's been up and down lately. There definitely have been some big champagne popping as well, sustainability no more, ESG is dead, and so on, celebrations, mainly across businesses, sometimes SMEs. But you, working in central banks, in research, and similar, you really well know that climate risks and sustainability is still very much part of the agenda, especially when it comes to the higher level of regulation coming onto banks and integration of climate risk in portfolios. And so I'm glad we have a topic focused on this as well. So without any further ado, this is the last section. I think you all know the rules and the structure here. I have noticed that I have some cards. I feel a lot of power with these, but I think so far it seems like everyone is doing quite well. So maybe without any further ado, we have 2 really highly interesting and topical presentations. And I think we can start with Jan Klačo on upgrading housing, the potential and limits of borrower-based measures, presenting a paper co-authored, I'll mention your colleagues as well, I thought, with Pierre Monin, Adam Banaj, Kristina Bojare, Rainer Martin, and also János Szakács. So please, the floor is yours.
Thank you very much. And also, first of all, congrats to all of you who are still here. It was a long journey, and I'm glad that you made it until the end. So Julian already listed all the co-authors. This was a project that was brought by Pierre from the Council on Economic Policies, and as his affiliation suggests, after all of these like intellectually challenging presentations and topics, this will be a bit more like easy to absorb talk. It will be more policy-oriented, but still, I think, very relevant and very topical. Let's see. So this is about what's the role in general or what's the potential role of borrower-based measures from the toolkit of macroprudential policy in terms of housing upgrade, also in light of the financial stability and climate objectives. I will talk a bit more about why we think this is important. And the second bullet, I think, makes it more clear why we have so many co-authors. So we are investigating the, at the time, available green borrower-based measures from 3 countries, Slovakia, Latvia, and Hungary. You heard yesterday that the Hungarian Central Bank has even a green mandate, so I think it's not a surprise that they are among the first countries who also implemented some or tried to implement some kind of green borrower-based measures. The third bullet point tells you why this is more a policy than a research topic. Policy because we will present you a survey results among the banks. And in the tentative conclusions, I will tell you that why is it still fine and how it helps us maybe to form or some kind of prior beliefs or prior hypotheses before we may engage with more data into some kind of a more analytical work. So let's start with BBMs and housing upgrade. What are we talking about, or why are we talking about the need of housing upgrade? All these numbers are from 2020 European Commission reports, and basically they say that buildings are responsible for about 40% of the EU's total energy consumption and approximately 1/3 of the EU's greenhouse gas emission. And this is huge, and these numbers are huge not just because of this huge LED screen, but because this really makes up a large share of energy consumptions. And moreover, it seems that roughly 3/4, 75% of EU buildings are energy inefficient at the moment, and almost all of these buildings will be still in use also in 2050. So if we would like to reach the EU's 55% emission reduction target by 2030, it's quite clear that you need to do something with these buildings because they won't become energy efficient by themselves. So you need to renovate, you need to change these buildings. And of course, some of these may also be in hands of like corporations, but a lot of these buildings are owned by households. So this is a topic that's very important, and it's on the table. There is an estimated amount of 275 billion euros that is needed to meet the EU's target by 2030. So it's important. It's not something that we may say that, okay, it's a marginally important topic. Housing upgrade is something we need to deal with. And of course, what's the problem is that many owners have limited financial resources and liquidity to finance some kind of large-scale renovations. And access to bank loans may be crucial for these households to engage in upgrading investments. So this credit channel can play an important role. On the other hand, I mean, as you may already well know, one of the currently very frequently being used macroprudential measure or part of these measures are borrower-based measures, and these measures are intending to somehow manage or drive the riskiness of the new flows of the loans. They are designed mainly to prevent excessive increase of loans and also excessive over-indebtedness and riskiness. These, just to mention, the most frequently used are loan-to-value limits, debt-to-income limits, debt service-to-income limits, and loan maturity limits. And there is already a huge empirical literature showing that these limits are working, so at least they can reduce the riskiness of the new flows. On the other hand, of course, these limits may put some burden on the flow of credit that is needed for renovation. So on the one hand, you need to renovate, you need loans. On the other hand, you are also following financial stability objectives, and you are managing the riskiness of these loans, and naturally then can be a crash of these two objectives. Also in terms that this need to renovate and this energy inefficiency can represent also a transition risk for the households. I will talk a bit later about this transition risk. So there is a natural question if somehow these borrower-based measures can be adjusted to reflect also on these climate objectives, and if they are adjusted, how they can contribute to this transition to more energy-efficient buildings. So what do we mean under this transition risk or transmission channels to these borrower-based measures? This is a transition risk because as we are going ahead with the need of transition to a more green economy, it can have impact both on the collateral value, on the value of the property, and both on the borrower solvency. Why on borrower solvency? We are talking about energy inefficient buildings, which means that these buildings represent higher bills for like energy payments and other costs. So compared to those households that live in a more energy efficient buildings, these households can pay more, which of course, because of a negative impact on their cash flow, impacts the borrower solvency and implicitly their probability of default if they have loans. And this PD is targeted usually by debt service to income or sometimes DTI limits. So this is the borrower solvency channel that may impact the setup of these DSTI limits. And on the other hand, in the future, when there is a higher demand for energy efficient buildings, of course, this can have a negative impact on the value of energy inefficient properties. So this can have a negative impact on collateral value, and that impacts loss given default, and this may have implications for LTV limits. And I'm now just quickly switching to this chart because even if it's a policy paper, I had to put at least one equation on the slides. Sorry for this. I know that you shouldn't, one shouldn't. But so basically, this transmission then may impact the setup of these borrower-based measures, and it depends on basically what is already included. So on the one hand, it can be a financial risk for those households that are in energy inefficient houses. On the other hand, it's a new financial opportunity, of course, for those borrowers who live in energy efficient houses, because for these households in energy inefficient houses, they can spend more on energy bills, and the houses may lose value, so this can lead to tightening. On the other hand, if this is counted for in the current borrower-based measures, the adjustment can lead to a borrower easing or easing of borrower-based measures. And so in the three countries, I will show you in a minute, in these three countries, it mainly led to this easing. So from basically this climate objective, as I already said, these borrower-based measures can be a hurdle to get funding for upgrade housing, and the regulators can relax borrower-based measures for these, like housing upgrades or purchasing of this energy efficient houses. Of course, if you ease limits, you will increase the riskiness. If you increase the riskiness, it can have implications for financial stability. So that's a question that what can be the approach. And usually what we see is that there can be some kind of a risk-neutral approach, that the way by which you ease these measures is aligned with how much the household will be better off, and then it can neutralize these financial stability implications, but I will also talk a bit more about it later on. Okay, so let's now see what is the current setup of borrower-based measures and these green BBMs in the 3 countries. I don't know if you can see it because it's quite low, but all 3 countries are relatively active in this field of borrower-based measures. In the first part there is Slovakia, of course, as I'm from the National Bank of Slovakia, I know the most from about these measures. And here, basically, the bank was able to set up limits since 2014 after the change of the regulation, and we were one of the countries with the highest increase of mortgage loans, because we didn't have a very huge impact of the financial crisis in 2008, because basically the mortgage market started in Slovakia in 2004, 2005. So there was not a huge impact, and therefore after the crisis we constantly grew in mortgage lending, and there was a huge increase in household indebtedness. Therefore, the National Bank was one of the countries which were the most active since the beginning of having responsibility of this policy. So we have basically the combination of all measures. We have debt-to-income limits, we have DSTI limits, we have loan-to-value limits, and also maturity limits. This is also the case of Latvia, who were also increasing in indebtedness. Therefore, they also increased a huge variety of loans. In case of Hungary, they were active pretty early on, because they had, of course, very bad memories from the crisis with all the FX lending. So they were among the first countries who imposed some LTV and DSTI limits. But since, I guess, 2012-13, once it was set up, they haven't changed so much. But there are some borrower-based measures also in Hungary, differentiating between lending purpose, between the currency and borrower income, and so on and so on. As I mentioned, all of these countries have made some changes to these borrower-based measures. And these changes are related to some extent, or not, these are related to this green renovation or purchasing energy efficient houses. And in all cases, there was some easing of these limits in case the loan goes for these purposes. In case of Slovakia, this is targeting consumer loans. We'll tell you in a moment why. In case of Latvia and Hungary, this is targeting mortgages as well. So in case of Slovakia, we eased the DSTI limit, where the maximum is currently 60%, and we increased it by 50 euros. I mean, it's not a lot, but we are talking about consumer loans, and with extending the maturity from 8 to 10 years, so basically it means that now people who are asking for these green consumer loans, they can get a loan which is higher by 2,000–3,000 euros. I will talk a bit later on in more details. In Latvia, the DTI ratio is increased from 6 to 8. The STI is increased from 40 to 45%, so this is more suitable for mortgages. And in case of Hungary, the DSTI is increased from 50 to 60%, and the LTV from 80 to 90%. So it seems that all of the countries had the approach that at the current limits there is no this renovation impact or this impact of transition risk, so there was some easing. So what are the objectives? In case of Slovakia, this is linked to consumer loans because people can now ask for funds from the Environment Agency scheme that is for renovation. And this is linked to some thresholds in energy savings. So the minimum threshold is 30%. If you can prove that you will save at least 30% in energy bills, you will get funds from this Recovery and Resolution Fund. And if you ask for it, you have to renovate first, you have to pay for it, and then you will get refunded. And in case someone does not have the cash, the own funds, and would like to renovate and qualifies for this, so they already has the approval for this from this agency, they can go to the banks and they can ask for this green consumer loan. So as we are talking about renovation, we are not talking about huge amounts. It's like maybe 20,000, 30,000 euros per household, and that's why it is covered by consumer loans. In case of Latvia, it's a bit more broad, so they are targeting those loans that are renovating or that are for purchasing of energy-efficient houses, and this is linked to the energy efficiency classification, and the eligibility ranges from C to A+, because usually when there is a new home build which is energy efficient, it's usually A or A+, and if there is a renovation, then this renovated home will end up with an energy certificate of B or C. So this is why these are the targets. And in case of Hungary, as I already mentioned, so they have a green mandate, and therefore they also would like to facilitate these purchases, but it may then have also like an implication on the green covered bond markets and so on and so forth. So there are some broader implications. So here we ended up in a situation where countries have just implemented some measures, but there was not so many data. We have some data for Slovakia, a bit, but we decided to have at least some kind of a prior to see that how it works. We run a survey among banks in these 3 countries. In case of Slovakia, these are only 3 banks, but these 3 banks are granting up to 85% of new consumer lending. So this is basically the majority of consumer loans that's targeted by these green measures. In Latvia, these are 6 banks. In Hungary, 7 banks. So, and we were asking in general about like green loan market prospects and impact of green BBMs. So I'm running out of time, so I will quickly show you the results. So first, current and expected demand for green loans. And this is now showing that what is the difference between the nice theory and the reality. Because in the theory, it may help. In reality, what banks said that in case of Slovakia and Latvia, they are the demand, in case of Hungary, the expected demand. So it was more like moderate or low. So none of the banks said that it's high. So it's more like, yes, there is demand, but this is not something that now we have a crowd of clients coming to this. And the expected demand was similar. So most of the banks expected either lower growth of these loans compared to other loans, or growth in the future in line with the other loans. And there were only a few banks that were expected faster growth than other loans. So there is some demand, but not huge. And when we asked about, okay, so what are the key messages that banks are emphasizing when marketing, or what can be the factors driving future demand for green loans, it's very much visible that basically climate issues are not on the forefront. So how banks would like to sell these products is that people can save because of energy savings, or because these are in some countries, some preferential loans with lower interest rates or longer maturities. So here on the left side, you can see that when marketing, what is important is energy cost savings, rates and fees, and enhanced property values. And yes, there is some environmental impact. Of course, they are also trying to marketing this, but to a less extent. And on the right side, you see that what can drive the future demand for green loans is mostly policies or subsidies promoting energy efficient construction, savings, attractive, again, rates, or attractive products or lower interest rates. And you see that something like desire for eco-friendly products or worries about possible asset depreciation, this is something that banks are not expecting to drive so much the future for these green loans. So still, if you would like to convince people, this is because it's financially attractive to them. When we asked about selected barriers to the growth of the green loans market, the most important was the absence of clear government support or subsidies or risk of changes in current prices, and then some expenses related to green projects, lack of attractive prices, or low supply of green projects and real estate. So here, what is important is that by themselves, it seems that green BBMs cannot change the market. So even in the slide before here, banks mentioned government support. So potentially, this is some part of green support that will be needed, and BBMs may only more or less complement. Then we asked them about how they see the changes in demand after these green BBMs have been implemented, and it was like some changes, but not so much. So there was not a situation where clients that were before out from the lending market started to flow into the mortgage market or into the lending market. So these green BBMs opened the floor for some clients, but it were usually the clients who have decided even before to go for this, and they could have made use of this preferential treatment. But as usually we are talking about marginal impact on loan availability, this is not a measure that will open the market for a huge share of clients previously being out. And so this was also important. We asked about the expected impact on credit risk profile of green loans and PDs and LGDs of the green loans compared to similar loans. And it seems that also in line with the calibration of these measures, the credit risk is more or less the same as for the other loans. So on the first table, you see that banks expect no impact on risk, or they see no impact on risk. And on the second, you see that these loans have similar PDs and similar LGDs compared to other non-green loans. Okay. Again, when we asked that what would help to support green lending and help to boost this energy efficient construction, again, what banks said that basically at the moment it's still costly. So they need either some kind of a governmental support, some kind of a state subsidy, or maybe some kind of other regulatory adjustments like capital reliefs or liquidity requirements that would also make these green loans more attractive to the banks to grant. So to wrap up quickly, this was a good exercise because even we do not have a huge analytical framework because we don't have so many data, this answer from the bank and also the current development. So in Slovakia, for example, I mentioned we have some data. It seems that the consumer loans with this green treatment, with these green BBMs, made up to 0.1 to 0.4% of the consumer loans granted by the banks. And that's not just because the banks. I've just checked, and currently there are more than 16,000 houses renovated in Slovakia. So there are more than 16,000 households who used the fund, and the fund paid more than 250 million euros for this renovation, and the overall number of these green consumer loans is not even 1,000. So really, it was a marginal help to some of the households, but was not a panacea. So this survey really helped us basically to name a spade. Yes. So this is not something that will be able to save this problem, but it can be a nice complement to other measures like governmental support and some other maybe also fiscal measures. So hopefully there we will be able to do also some follow-up once more data will flow in, and we'll be able to do also some analytical work, but this at least helped us really to drive or some kind of prior expectations and hypotheses about the impact of this green BBM. So with this, I will stop, and thank you very much for your attention.
Thank you very much. Thank you, and as I said, really highly relevant. This is actually one of the biggest topics we also hear in Czechia on different working groups with Czech Green Building Council and so on. So I hope there will be some space for discussion, for some questions. But now, to save time, let's go to our discussant, Alessandro Chiari from Czech National Bank, to provide some input and some feedback.
Yes.
Please.
Can you hear me, Al?
Yes.
Okay, thank you. And okay. So, first of all, thank you all of us for inviting me. In general, I'm very happy to be here, and it was a very interesting topic for me to read more about and to think more about. So thank you very much for the challenge. Of course, the usual disclaimer applies, so all my opinions here are mine and not from the Czech National Bank. So upgrading housing, basically, the topic itself, I consider it, of course, very important. We know that, buildings, as, summarizing the goals of that we have, let's say, here in the European Union, buildings account for 40% of UN energy. They do a lot of emissions. We need, there is an estimation by the European Commission that 275 billion per year are needed. And in general, there is this need for household and banks that should undertake this renovation. It cannot come only from the state. So in something needs to we need to do something to move also the private money. So the paper, the goal of this paper for me was interesting to understand exactly if we're able to do something as central banks to actually kind of improve, kind of push this kind of renovation, and whether what kind of consequence it has. Methodology here for the moment, as you said, for the moment there is not really a methodology. It's just more looking at the surveys, see what can be the theoretical impact on by using this BBM, relaxing these BBM limits. In general, there is an idea that it could improve energy efficiency and can enhance property values. That could push to energy upgrades, so lower utility bills and effectively increasing the borrower disposable income. But possibly there will be a need of public support alongside the BBM. And then, they use these case studies, Slovakia, Latvia, and Hungary, which, as you said, probably Hungary is the most, let's say, high case where, they are implementing more strong BBM relaxation. And in general, they're doing some nice analysis with the surveys to see whatever they're doing and what are the possible expected results from this relaxation. So the key findings, target BBM can effectively moderately increase bank lending. There is a risk-neutral design is possible, so the energy cost savings and better collateral values can effectively maintain financial stability. And but it's not a silver bullet, so the measure adopted for the moment, it looks like the borrowers and the banks, they do not have so much appetite for it. So there is, for the moment, at least only with BBM, only a limited scope and, marginal incentives. Strength of the paper for me, is mostly looking at something that will be more and more important in the future. The timely is perfect, that's meaning that we need to think about this now and try to act now. And in general, you can do a lot of nice research in synergy with different institutions in this case. So talking about limitations, well, of course, there is, for the moment, we have a very modest impact. And, here I will I will, let's say, reflect more on, like, what kind of data I could find that, like, it could be interesting to look at in order to understand if we can have a real impact from this point of view. Is for sure dependence on our policy. If you want to have a real impact, is not, just BBM probably is not enough to really push for this kind of change. And there is also a calibration uncertainty. So we have different countries, different institutional setting, different also appetite probably for this kind of renovation. So it's possible that, like, you cannot really find a equilibrium setting where say, okay, after, like, under this kind of percentage ratios of LTV or DSTI, you're gonna have this kind of results. So, in the long term, these results can be quite unknown of what you're gonna get. Methodology, here I go, let's say, quite fast because, just saying that, like, there is very recent evidence database, so, there's still, like, a lot of time, a long way before, like, we really are able to understand what kind of outcomes can be in this, at least in these countries. I'm going to talk later about Italy, like what can we draw, what kind of lessons can we draw from Italy. And so for the moment, you can just, think about, like, it's interesting mostly to look at what are, like, the expectations in this case, rather than, like, the actual outcomes. Plus, also the fact that, like, there's the risk metrics are more self-reported. So in the end, like, we don't know exactly, like, they don't do any estimation or, like, of what there could be, like, the ideal ratios that could be useful to you. And like, until we don't have data, we cannot do any counterfactual. So, deepen the for event study to understand exactly which is the best one. Then, I skip here the parts of, like, the parts of Latvia, Hungary, and Slovakia. Everybody has their own setting, and so it's interesting. It could be interesting later to what they can actually do. So what can we actually do to, let's say, abroad this kind of research? Of course, like, we need to expand data collection. As we're talking before, the, like, default rates, having, like, the change in the property values, it will be interesting, and, like, also how much actually energy savings can be. It can be interesting, like, do some diff between countries, try to understand effectively if like, the portion of energy savings, it goes exactly to boost the income of the borrowers, and like, try to see what can be done to improve policy calibration. Enhance borrower inclusion and coordinate policy efforts. Here is more about understanding, like, whether there are some spillovers as well from, let's say, one or another measure. So if, for example, we see that, we relax the BBM for this kind of loans, if there can be also the possibility for government agency or monetary authorities to, let's say, do other kind of policies to, push, let's say, more borrowers to use this kind of instruments, and, like, also kind of enhance the knowledge of the borrowers to this kind of level. So here I wanted to discuss a bit, like, what actually can we draw for, like, a real case that, like, it can be interesting. From 2020 to 2021 in Italy, we had something called a temporary tax incentive that we called the super bonus, where we did a 110% deduction to promote energy efficiency upgrades in residential buildings. So, Italy from 2020 effectively started doing heavy, but we were talking about really heavy subsidies to try to renovate the efficiency of the buildings in Italy. And the Bank of Italy really did a lot of work on this kind of topic, and basically, these are the drawings that, like, they got from this. Emission reductions were positive, but very modest. Above all, like, it's very interesting that the ecological payback estimated at best it was 40 years in the best case. There had cases where actually the expected utility of the life of the houses were going to expire before you could see some let's say, the payback from this kind of subsidies. So in the end, in many cases, like, you are going to end up maybe restructuring again your house, or maybe even, like, in the need of tearing it down before you see some payback from this kind of subsidies. The fiscal cost was very heavy. I think if you sum all the years up until now, you go above 200 billion, 220 billions of tax credits. So, if you go back to the first slide where we're saying, yeah, that according to European Union, we need to have 275 billion per year. Italy did it in 4 years altogether, yeah. And the distribution and the policy was very skewed because, of course, they didn't do any, let's say, based on the income. So everything was about wealth, everything has been very much used by the wealthier households. So the policy lessons that have been taken from that Bank of Italy took from this kind of experience is, as said, probably these kind of subsidies, they could be useful if you target really just the low-income households and the worst performance buildings. So, where the marginal utility can be actually higher. But you really need to and of course, some BBM relaxation policies can be useful, but you cannot exaggerate with the subsidies. They can be really, and they really need to be limited. Here you see basically what there was the impact from, this taken from this paper of the Bank of Italy. You see this green part, that from 2020 of what exactly has been incentivized by the super bonus, and you see these billions and billions in the investment incentivized by it, and so you see, okay, subsidies can really push this energy efficiency effort in a country, but if in the end you need to think that yeah, thank you, that the energy cost savings cannot be efficient, and in general, it's going to be too cost. It's not cost effective. So basically, the cost of public finance is just too high. You draw the lessons. The possible lesson. Of course, this is not a complete the final decision, the final judgment. That, or we can do something, but very little about it. Or what we're going to achieve, it's not, the challenge of fighting climate change. Cannot be done only on housing, or probably housing is not the main part that we can cover to achieve this kind of climate change transmission. Finally. So conclusion and policy, this is still, I think, an area where you can have a lot of good results and where we need more research. BBM is probably not a silver bullet, as the research of the National Bank of Slovakia said, but it can help. Probably, at least from what I can see from Italian experience, subsidies are not the main help for this. But this remains an open research question, and I think we can do a lot of nice work about it. Thank you.
Thank you, Alessandro. And we do have still a few more minutes, I believe. I can actually see the clock, so I'm just counting in my head. But I mean, as long as it makes sense. Would you like to maybe react briefly, or should we just open the questions?
Maybe just one point. I just realized that when we are talking about this not having a data, so a natural first step you can do is to take a DSG model and try to playing with the calibration. And we had one of the first visiting researcher projects with Maria Teresa Punzi, who came and were exactly looking in this DSG setup on the impact of borrower-based measures, more on the financial, on the corporates, on the firms rather than households. But I mean, the impact of calibration is huge, because for her, the main result was that the most effective measure is the one-to-one capital requirement, which is, I think, not a borrower-based measure that we would like to apply on households. So yes, so I will be glad if we can follow up and proceed with the project also with data. And thank you very much for your comments. And I mean, it was a bit pessimistic because we finished with the hope of the help of the state subsidy, and then you just said that no, it doesn't work. So we are looking for a solution.
For me, the lesson is if you want to do state subsidies, the case of Italy is the one to study about what not to do. Let's say, but very limited. I think it can have some usefulness.
Thank you. Sounds good. Okay, well, let's open to questions. If there's any questions, we have the microphone. Any reactions, comments, or questions? Joachim, please.
The obvious one, probably we talked about this already, is given the way I understand it in Slovakia, at least, the income-based measures, they always already take into account some subsistence consumption that a household needs to do or something like this. Why wouldn't you simply in this equation include the cost of energy you have to spend And you implicitly, if you save on that, you get an automatic relaxation that is sort of one-to-one with the cost savings you do, because you have to spend less on the, you know what I mean? Like I think you already subtract the subsistence income, why not also subtract the cost of spending, and then you have it correctly calculated?
Yeah, I mean, it's more a question on the guys who were setting up these adjustments, but I think this 50 euros was something, after the discussion, the banks was something like an average impact. So they were indeed like taking into account the savings in energy costs, and this was kind of an average that that went through this consumer loan payments. So that was the aim, but they wanted to come up with something simple and not with percentages, I guess.
Any more questions? No? I might actually ask a question. I'll just use the platform here. With slightly different background, not necessarily as an expert on banking sector or policy, so the one slide you have with the equation, so I mean, what you essentially said is also that the assumption here with the energy efficiency upgrades is to increase retention of value, or potentially I actually wrote it down as well, should lead to higher value as such, given the energy efficiency measures. But then it's interesting to hear this, and I sit here and also I understand the implications of CRR. We have EPBD, right? We have all these, on the one hand, all these regulation, both on the banking sector, all on the housing sector. This is all happening. And then I sit on the Green Building Council in Czechia. I go to some discussions with, for example, different real estate consultants from JLL to Cushman and all these valuations team. And one of the biggest discussions still, given all the regulation and all the pressures and assumptions, is we don't see any, let's say, integration of ESG and energy efficiency measures being translated in the interest rates at banks, right? So we had a big discussion at the conference we did recently, where we had quite a few banks, Ministry of Industry, Ministry of Finance, and so on. And it was also about how EPBD and how some of the ESG measures are actually going to translate into potentially lower interest rates when you come with two houses of similar value, for example, but one is much more ecological, much greener, and has much higher energy efficiency. And if I remember correctly, like there's still no, despite some specific products, like the ESG value is not reflected essentially in loan to value or in the interest rate. So I don't know, like based on your discussions with banks and some of the research, like is my understanding correct that we don't really see this reflected in the interest rates? And if so, is it just maybe the loan to value methodology they use? Is it based on the current prices? They don't really maybe use future development of policy, energy regulation. So what exactly is why we don't see any reflection of better interest rates for some of the more ecological and greener buildings yet?
I guess my answer is that that's a very good question. I would love to know. What I remember that 2-3 years ago, when we organized a Green Day, and banks were also involved, and at that time they were complaining about not having access to energy certificates.
Yep.
So there can be still some hurdles on the secondary market. I guess on the primary market this is not such a huge issue because you have the certificates. So, but to set up the systems, I would say that rather you need to cover the whole market, and there can be some problems. The other question that, yeah, I mean, you mentioned that this ESG or this energy efficiency can be reflected in the value. And so if it's reflected in the value, if it's reflected in the LTV, if it is necessary to also reflect it in the interest rate, but I guess it's a longer discussion also with the banks. But at the moment, it seems that that in the systems it's not. And also, I mean, like I was told at the university that the value of the real estate is like the value of a picture. There is demand, there is supply, and if they met, then there is the price. And until the demand will not adjust for this, and based on this survey, it seems that it's still not adjusting for this ESG, and then maybe there will be not a market push on the banks.
I'm also curious about the development of the discussion, and we don't have time now, but even at this point, I think I have 3 or 4 invites to different discussions with developers and real estate associations exactly on that topic, because it's especially developers and construction companies willing to spend more money if it's we can see the retention and translation into value. But one of the biggest topics, I think, currently in Prague, where I sit, when it comes to ESG and some kind of tangible discussions about integration of ESG and climate risk, has been real estate lately. So I think this is a very topical, very good, timely research. Okay, let's move on. And now the second and last presentation of the day. So we have Boris Fischera from Slovak Academy of Science, and the presentation will focus on financial deepening and carbon emissions intensity, evidence from a global sample of countries. Please, the floor is yours.
Perfect. Super. Thank you very much, and thanks also to the organizers for including this paper in this wonderful session. So essentially, in this paper, we are going to be looking at the consequence of financial deepening, but whereas most of the literature looks at the consequence of financial deepening for economic development, in this research, we sort of extend on the literature that looks at the consequences of financial deepening, financial development for climate and for CO2 emissions in particular. So essentially, in this presentation, I will firstly talk a little bit about our motivation for this research and about the framework that we try to sort of use to explain our results. Then I will provide you with some initial results of the analysis that we have done at a country-level data. And then I will also talk a little bit about some strategies that we are considering about identifying specifically the causal effect of financial development or financial deepening. Without further ado, let me start with some stylized facts. So on the next chart, you can essentially see for our global sample of countries, right, because we are using here country-level data, the changes in the 2 key variables of interest that we are looking at. That is, just to frame it at the very beginning, so we are looking when we talk about financial deepening, at the credit to GDP as our primary proxy, though we use also some other proxies to approximate financial deepening, right? So the change or the increase in credit to GDP, we equate with financial deepening. And secondly, we have our primary outcome variable that would be CO2 emissions intensity. So this is not CO2 emissions overall, but essentially how many kilograms of CO2 emissions are produced when $1 of GDP of a country is produced. And here we see essentially the changes between 1999 and 2019, so over a 20 years period. And essentially what you can see is that in our global sample of 125 countries, we can see a lot of different patterns for different countries, right? So there is quite a lot of different outcomes. So for example, there are some countries that essentially increase both their financial debt and also their CO2 emissions intensity, but there are also others that increase essentially just their financial debt, but see some decrease in their CO2 emissions intensity, right? So there is some heterogeneity there, and this obviously makes it a little bit challenging also to identify some of the causal effects. But nevertheless, we also want to essentially exploit this heterogeneity to try to investigate why are there differences between these patterns, right? So why in some places you have essentially financial debt and combined with CO2 emissions. And obviously, we want to investigate whether there is some relationship between the two. And why in some other places the relationship is a little bit different, right? And just to show this on obviously a very extreme example, very opposite countries, but nevertheless, just as a sort of a motivation, so here you can see 2 very different countries, Australia, Vietnam. But nevertheless, in these 2 countries, you see a completely different relationship when it comes to the financial debt and CO2 emissions intensity, right? So in Australia, almost a perfect negative correlation, whereas in Vietnam, there's a very positive correlation. Obviously, these 2 countries are at different levels of economic development, but nevertheless, in our research, we essentially firstly want to investigate, okay, so in a global sample of countries, what is more rather the case? So does it look rather like Vietnam, or does it look rather like Australia? So does financial debt potentially help with reducing CO2 emissions? And secondly, we want to see whether there are some potential other factors, just other than obviously the different stage of economic development, that might explain these different patterns, right? Because in our database, these are very extreme examples, but we also see some emerging economies that have rather a negative relationship and some advanced economies that have a rather positive relationship. And the primary motivation for our research here is essentially that, as I was mentioning at the beginning, financial deepening is usually associated with positive effects for economic development, right? So that's something that policymakers would often strive, because there would be an advice, increase financial debt of your economy, improve the financial system, and then there will be higher economic growth. But there is also this open empirical question. So what about the consequences of this financial deepening for the environment, right? So can financial deepening, can the greater depth of the financial system help with the green transition, which is obviously going to be associated, or which is already associated with significant costs, or rather, generally speaking, is the greater depth of the financial system associated with worse environmental outcomes. So generally speaking, as I mentioned at the beginning, so when we look just at the data, we see all kinds of different relationships. Policymakers generally expect that financial debt obviously has positive effects for the economy, and generally there is also expectation that the financial system should play an important role in the green transition, so that the greater financial debt could help to finance, essentially, the greater the green transition. When it comes then to theory, at the moment, there is, at least to the best of our knowledge, no unified theoretical framework that would sort of link financial debt with the environmental outcomes. So the closest one can get to some more formalized theoretical model in this area is essentially an endogenous growth model with technological transition of Acemoglu et al., where essentially an important parameter that influences the sustainable economic growth is the elasticity of transmission from what they call energy inefficient or not clean towards energy efficient or clean sectors of the economy. And we argue in our empirical analysis that the financial system might play a role here by influencing this elasticity, right? So when the banks are prepared and ready to finance the transition towards not necessarily always green, but more energy efficient, more energy saving, that is more modern technologies and industries, then they might help with the green transition. And essentially, just given that there is not that much empirical evidence, particularly for a larger sample of countries, so we try to extend this evidence by doing a simple empirical analysis and trying to see how does it look like. Right? Just then, let us formulate some priors. So what do we expect, generally speaking, based on our review of the literature? So obviously, one could imagine, one could build a story that greater financial depth, that the greater size of the banking sector might have both a positive or a negative effect, as we have seen already in these stylized facts. Because if the banks rather finance consumption or rather finance essentially established industries, established technologies, established sectors, established firms, then there might be a positive relationship, which in this case means not necessarily a good outcome for the society, because it means higher financial debt leads to higher CO2 emissions intensity. Alternatively, if banks opt to finance essentially rather more risky, newer technologies that are then likely to be also more energy efficient and thus by extension also cleaner, then we might observe a negative relationship. Now, based on some sort of literature review, one could argue that banks generally are not very good at financing sort of more riskier investments, and therefore one could argue that probably one would observe a positive relationship, right? Because generally speaking, it has already been shown that banks operate when it comes to providing loans, particularly to firms, at a rather shorter time horizon, and therefore, with this shorter loan maturity, they might just not take into account the environmental consequences, right? So that would be one sort of an explanation why, essentially, a financial debt might actually lead to higher CO2 emissions intensity, because banks just do not take this aspect into account. Furthermore, banks, generally speaking, have been shown to be more technologically conservative, right? So generally speaking, they do not normally, or to a greater extent, finance more innovative and riskier investments. That could also be generally the green investments. And finally, the banks, generally speaking, when there is an expansion, when it comes to the provision of credit, then that helps every single part of the economy. So that definitely is going to help also the polluting industries, right? So there would be essentially these kind of three arguments that we could build based on the existing literature that would sort of support the conjecture that one could expect the greater financial debt when measured through banking system to have a positive relationship with CO2 emissions intensity, that rather thus leading to higher CO2 emissions. But if that is the case, then that would essentially mean or imply that there is a trade-off, right? Because generally speaking, we would argue that financial debt, financial deepening is good for the economic performance, good for economic development. But if it also, at the same time, leads to an adverse environmental outcome, that is to higher CO2 emissions intensity of the economy, then there is a trade-off for policymakers to consider. And therefore, in the second part of the analysis, what we do is we try to exploit the heterogeneity of our panel of countries to see, just essentially, let us call it some conditional correlations, whether some characteristics of these countries might influence the differences in this relationship and might, for example, help to mitigate this trade-off, right? So, for example, again, based on the current reading of the literature, we ask if it is really the case, when one looks at a larger sample of countries, that in countries with stricter environmental regulation, you would see a less positive effect of financial deepening on the CO2 emissions intensity. Right? And we'll also look at some other institutional characteristics because, for example, there is a nice paper by Regeza et al., which argues that particularly when banks operate in a more stable institutional environment, then generally speaking, they are prepared to finance more long-term loans, and they are able then to finance more riskier investments, which we could equate then with sort of newer, more greener, and more energy-efficient investments that could help to reduce the CO2 footprint of bank lending. Furthermore, there's already been some evidence shown, and actually some simple empirical exercise that we also do confirms this, that financial markets are better at financing riskier investments, and they are also better at financing greener investments, and thus we also try to investigate whether, if banking system operates in a country which has a relatively more developed financial system, whether this competition from the more developed financial system forces the banks to sort of have funding, to provide funding for more long-term investments, which again we equate with sort of like riskier and cleaner investments. And finally, we also consider whether essentially the ownership structure of the banking sector, that is whether it is more foreign-owned, whether this also has some effect, right? Because one could again argue that if there is an influx of foreign banks, that these might either create competition or might bring practices from other countries which might help to essentially tilt the bank lending towards greener and more energy-efficient investments. So this would be essentially our hypothesis and what we do about it. Well, at the moment, our analysis is actually very simple. So as I was mentioning already, we try to see what's the effect on average of financial deepening proxied by credit to GDP increases, but also we have some robustness with some other proxies on CO2 emissions intensity of the economy. And we try to see, so what is the, we could say, state-dependent effect, right? So whether these institutional characteristics help to potentially mitigate the positive effect of financial debt on CO2 emissions intensity. At the moment, we have country-level data, so we have a panel data set of 125 countries over the 30 years, from 1990 to 2019, and we use local projections approach to sort of run our regressions. And just to give you a little bit of some insight into our main findings, so we do find that financial deepening increases CO2 emissions intensity of the economy on average. However, some institutional characteristics help. And generally, our findings indicate that it depends at what stage of the green transition you are as to what of the or which of the institutional characteristics are helpful. So we find that for countries which have initially a high level of CO2 emissions intensity, so for these countries, the number of climate change laws, which we equate with the strictness of environment regulations, is very helpful at lowering the carbon footprint of financial deepening. However, for countries which have already lower CO2 emissions intensity of the economy, actually this is no longer the case. So in that case, it is essentially general institutional environment that seems to be better. And I'll then talk about why we sort of, or how we rather explain these findings. And so just so to conclude this part, again, our results indicated, yes, there is a trade-off between the effect of financial deepening on economic growth and on the environment, but this trade-off can be managed, right? So there are some, at least from this country-level data, it appears that there is some evidence of the differences there, right? So just to already go to the empirical specification that we run, very simple one. So we use local projections approach. Let me rather put this slide here so that you can see the equation better. So essentially, we have our outcome variable, which is the CO2 emissions intensity of the economy, and our primary sort of variable of interest is then our proxy for financial deepening, which would be the change in the credit to GDP ratio. We also include some control variables in the regression, like economic growth, proxy for banking crises, population. We also include a large set of both country and time effects. But we keep the specification parsimonious because then essentially we can keep the large sample of countries so that we can really then exploit the heterogeneity of the estimations. So this would be the baseline regression. And then we also run what I can say is a conditional or state-dependent estimation, where we again try to sort of exploit this heterogeneity across the panel to see what factors help. And then we run this kind of state-dependent local projections, which essentially means that we specify some indicator variable for better and worse, essentially. So we could say better institutional environment versus worse institutional environment. So this would be a proxy for better institutional environment or for higher number of climate change laws. And this would be essentially an indicator for the other group of countries or other group of observations. Here in this specification, I'm being trying to keep it parsimonious, but obviously in state-dependent local projections, you then interact the indicator variable with every single of the variables themselves to have this kind of state-dependent effect. And then with this specification, we can easily estimate the nonlinear or state-dependent impulse responses of CO2 emissions intensity of the economy vis-a-vis the financial debt of the economy. And this is essentially our baseline finding, which appears quite robust across different specifications that we run. So here, this is a response of CO2 emissions intensity over a 5-year horizon after the shock to an increase in credit to GDP by 1 percentage point. Just to show you, or give you a little bit of a perspective about the magnitude of this effect. So over a 5-year period, in our sample, on average, the CO2 emissions intensity of the economy falls by about 4.5%. With an increase in financial debt by 1 standard deviation, this effect decreases from this average change decreases from 4.5 to 3.9. Right? So that's definitely not a large effect, but it is some effect, definitely. And again, we sort of run a number of different robustness checks to essentially see whether this result is robust, and this kind of standard robustness check to address the issues in the panel estimations, like using a different proxy, using different estimator, addressing nickel bias or cross-sectional dependence. All of them corroborate our findings. This finding also holds for using different proxies for financial debt, like the Financial Development Index of Svirizenka. Moreover, one obviously clear criticism of this could be that this is endogenous, and of course that is the case, and essentially credit to GDP grows when the economy is doing better. So this could be driving our results. One sort of a reassuring finding is, and here if I may just ask you to bring us to this stock market result, thank you. So essentially also the stock market generally grows when the economy is doing well. So just when we rerun this estimation, but use also the stock market capitalization and look at the response of CO2 emissions to stock market capitalization, well, then we actually see a negative effect. Right? So interestingly, when the stock markets become larger, it does appear that they do help with sort of reducing the CO2 emissions intensity of the economy. And this also does indicate that maybe the previous result is not necessarily driven purely by essentially this correlation, okay, higher economic growth, higher financial debt. If we could just go back. Oh, thank you. Nevertheless, we also do some, thank you. Some sort of analysis with some trying to address essentially the endogeneity issue, which still is there in this particular case. So if I might ask you to just bring us to this AIPW estimator part. So one sort of a way that we also address, to also use in order to address the endogeneity of financial debt or financial development is essentially that we use the AIPW estimator of Jordan and Taylor 2016. And in this estimator, it consists of essentially several steps. But the idea of this estimator primarily is that, oftentimes in macroeconomics, when we try to identify some effects, we often have this kind of well-identified shocks, like in the monetary policy, the high-frequency identification. But these shocks often explain just a small variation in terms of the actual variable of interest. And so there is some strand of literature, like recently McLeary and Tenreiro, which argues that, well, one should maybe look at larger shocks to trade maybe identification for larger variance. And this is essentially what this AIPW estimator enables us, because then we have to identify some episodes of credit booms or financial deepenings that are larger. So in our case, we followed literature and we just identified credit booms, 114 episodes, as situations when the credit to GDP has increased by more than a standard deviation at the country level, right? And then we look at the effect of these larger increases in financial debt on the CO2 emissions intensity, which is essentially this dashed line. So we again see this positive relationship, but nevertheless, one could still argue that this is still endogenous. So this AIPW estimator, what it enables us to do is it enables us to run essentially a first-stage regression where we try to explain, in this case, as our dependent variable, the indicator variable for the larger increase in credit to GDP ratio, or we could say credit boom, with some simple macroeconomic factors, again, what we could find with regard, which should be sort of relevant based on the literature for this kind of credit boom episodes. We do see, it does seem to provide sensible, explainable results. So for example, banking crisis in this year is associated negatively with the probability of having a credit boom or a large increase in credit to GDP next year. GDP growth is positively associated with this probability, or FDI inflows are also positively associated with the probability. And based on this probit model, we then essentially, thank you, can run essentially second stage regression, which is essentially what we have seen previously on the previous slide here. But we reweight, or we run this regression, this local projection, by weighting it with the probabilities obtained from the first stage regression, giving an inverse probability that is giving a greater weight to those episodes that are unlikely, given the first stage model. And again, we do find, in this case, statistically more better identified response. So this could kind of indicate for us that, yes, this is, sorry, if we could just go back then. Yeah, thank you. So this does provide some evidence that, yes, maybe there is some causality there. We also use some instrumental variable approach to essentially corroborate our findings in other robustness checks, and it does corroborate our main findings. Now, just to then conclude with our empirical analysis, so we then run this kind of state-dependent local projections to see whether some of these kind of institutional characteristics sort of help to explain some of the heterogeneity. And generally, for all of these institutional characteristics, the red line is essentially the worst outcome, right? So this would be, for example, lower financial markets to financial institutions ratio, or over here, that would be lower number of climate change laws. And generally speaking, we see that better institutions do seem to attenuate this positive effect of financial deepening on CO2 emissions intensity. Of course, one argumentation would be, yes, but generally countries with higher number of environmental laws, for example, are going to be rich countries. So therefore, this green line is explained by advanced countries and not by having a larger number of climate change laws or by having better institutions proxied by rule of law index. So to address this criticism, yes, I will be finishing, thank you.
No worries.
So just to address this criticism, what we do is essentially we let these nonlinearities compete with each other. And that is, we simply estimate the specification above, where we essentially have the baseline effect, which is the red line, which is essentially the basic effect of financial debt on CO2 emissions intensity. The blue line is state-dependent effect of being advanced economy. And the green line is then having these better institutions, right? Proxied by higher number of climate change laws or rule of law, etc. And essentially, what we find is that it does not appear that these results are actually driven by being advanced, right? So generally speaking, the effect of being advanced is around 0 for all of the specifications. So generally speaking, it does seem that this institutional quality helps to lower the carbon footprint of the financial deepening of bank lending, right? Again, we conduct a couple of robustness checks, but in the interest of time, let me just keep to the conclusions. So, as I was mentioning, simple empirical analysis, we show that increase in financial debt is associated with higher CO2 emissions intensity. We also provide a little bit of evidence that this might be causal. And given this result, it could seem that there is a trade-off between the positive effect of financial development for economic performance and its adverse effect for the environment. But nevertheless, we show that institutional characteristics are important, particularly better institutional environment in terms of, in our case, proxied simply by rule of law, seems to attenuate this effect, as does the climate, as does the strictness of the climate regulations. And let me pause here. So thank you very much for the attention, and I'm looking forward to the discussion and to any comments or criticisms that you might have. Thank you.
Great, thank you so much. And just for the sake of time, let's move to the discussion part, and by the discussant Vladimir Otrashenko, the senior researcher from National Bank of Slovakia. So the floor is yours, please.
How do I switch off? I'll switch. This one.
You would think I know, but...
Hello, everyone. Thank you for having me here. And I will be discussing this paper. So before starting discussing this paper, I would like to convince you that this is an important topic. Maybe some of you already convinced about this. But I start with a short video, okay, which takes about 30 seconds. But basically, what it shows is that how the temperature evolves over the time, over the 100 years, okay? So here we have our baseline is a temperature between 1950 and 1980, okay? And then you subtract the average temperature, annual temperature for each of the country here from this baseline, okay? So 0 means on this chart means there is no change. If it's above the zero, it means that temperature increase. If it's below the zero, the temperature decrease. Okay. Here you observe all the countries here, Slovakia here, okay? And on the upper corner, you observe the global trend. So let's see what is happening over the 1 century. And this is what we have.
No music.
Looking at our global trend, okay? Yeah, now let's stop here. And look, some of the countries hit +2 degrees, while we are still talking 1.5 by the end of this century. But looking at all the majority of the countries, they hit already, most of them, +1 degree Celsius. So for me, and I always have this question when I'm talking with the people, okay, let's target 1.5 by the end of the century and see what is happening. I say, can we manage that? They say, yeah, sure. But I say, then I ask the subsequent question, have you seen the charts? And that is a good question, okay? So now you can think as well, can we hit this threshold 1.5 by the end of the century? So why it is important for our case and for the emission particularly, because what is the most literature say, this temperature increase due to anthropogenic emission, in particular carbon emission, okay? So next, what I will be showing here, future projections of the economies, okay? That coming from the paper COTS 2024, Nature, that coming with a question mark for some reason. And here, what we observe, we have, let's say, orange or red scenario, business as usual is nothing is done. And we have a blue, if we start combating the climate change, okay? By the start combating climate change, it means we start do it yesterday. So what is happening by 2050, the gross regional product reduction will be by 20%. There are some critiques about with this estimation and with these projections, but seems authors respond this reliably. So let's back to the Boris paper. What the authors do, they examine the impact of the financial deepening on carbon intensity across countries, employing the Yordas approach with unbalanced data. And for financial deepening, they use the ratio of bank credit to the private sector over GDP. So next, what they do, they also conduct heterogeneity analysis based on the rule of law, number of climate change regulation, and the ownership. Even though the Boris mentioned in the paper that is not a channel or the mechanism, I still believe that is a possible of the description of the mechanism and channels in this paper. Next, the main finding of this paper is that there is a positive relationship or the association between financial deepening and the carbon dioxide emission intensity, and the environmental regulation and good institution mitigates this effect. I'm also aware that Boris is aware of the weakest point that I will hit right now, but I also suggest how to overcome this, okay? So when you're talking about emissions on one hand and the economic development on the other hand, and this is what you're meaning by the financial deepening, is that exactly reminds me environmental Kuznets curve. Here we have emission, here we have a development. But if you observe this is inverted U shape, and it's driven by the wealth and technology, and this is what you talk. Okay? So implementing this theoretical model or modify this theoretical model in your paper basically brings your paper to next level, okay? By this, you can robustly say, we have this hypothesis, and let's test where the group of our countries located in this first stage, okay, or the overcoming the tipping point. And identifying the tipping point is also might be interesting, okay, itself. So then you can use the heterogeneity analysis based on the World Bank classification through the high-income and low-income country groups and see where this country located in this environmental Kuznets curve. Yeah. So basically, the theoretical background of the conceptual framework helps you to avoid all this discussion regarding the causality, whether it goes through this variable or through this variable or through this door. In your case, it will be not matter, and some of these will be less relevant. Okay? But still, there are some minor suggestions regarding your manuscript that may improve it, and specifically if you can split the introduction, keep most important things in the introduction, say, okay, this is my research question, and this is my main findings, because when I started reading, it was a little bit difficult, because since the research question was on the 4th page, and it was already a lot. And also develop the background section. Okay, so you remove all this literature from introduction, discuss what has been done in the literature, and also help to understand for the reader what is your contribution. And also introduce the theoretical section or conceptual framework as you wish. Okay? Then the question regarding the causality, financial deepening affects the carbon dioxide, or carbon dioxide affecting financial deepening may be less relevant in your case. But I also find the horizon equal to 5 years is important, and you need to discuss why you think that financial deepening captured this impact within the 5 years. Okay? Right now it says it's similar to this paper, which is not maybe sufficient in your case. Okay, some justification of explanatory variables definitely required, because you need to say why they needed in this equation and what they represent exactly, wealth, technological development, etc. I have concerns regarding the leads. Not sure they need to be there in the main regression, maybe in robustness check, in order to see it captures all the important association between financial deepening and intensity. And adjust your contribution. I think contribution is one of the important, but unfortunately you just mentioned as a finding. So, and I don't think that is sufficient. Okay, thank you.
Okay, well, thank you very much for the input as well, Vladimir. And we still have a little bit of time, maybe even for questions, but I would let you react. I saw you writing notes, so please.
Yeah, thank you very much. Thank you for the excellent discussion, for your comments. Certainly a lot of them things that will be helpful for us. So definitely, I mean, for the Kuznets curve, for example, we are just controlling at the moment, but there is nothing at all that we would be like doing specifically about looking like at which stage of the development you are and potentially building a theoretical framework. So that's something that certainly would definitely help the paper, as you have mentioned, and that's something we are looking into it. Thank you also for the suggestions. Yes, the introduction is very long, 5 pages, I think, if I remember. So yes, definitely we could sort of split this up. With regards to the causality or the simultaneity bias, so we try to sort of address this partly by this APW estimator, which, however, requires us to then have like episodes instead of specifically like financial deepening. We have some instrument which is maybe strong, but is not super strong. So there are some attempts at least, but yes, definitely it's something we can take a closer look at. With regards to the horizon, I mean, one thing is that we would generally expect like the effect of bank lending and the growing financial debt to have some lag in influencing CO2 emissions intensity, because it takes a little bit of time once the credit goes up. What then happens with the investments, so whether there is essentially some increased consumption or not. But partly also we are limited with the short time right? Because we have just this 30 years of data, so any additional like horizon sort of leads to loss of a number of observations that we have. So at the moment we have tested this, but we could definitely like take a look at possibilities of either extending or shortening it and seeing how it affects our results. And yeah, with regards to leads, there have been some papers that suggest that in the local projections you should be including leads. But I agree that I have also heard from a lot of people like you, then it might not necessarily be necessary. So we have actually done some robustness check, dropping them. It doesn't influence anything, so they are insignificant in the estimations. So therefore, I think we will follow what you have suggested, just do a robustness with them and do the baseline without. And yes, thank you also for this suggestion that we should rather focus also on this second part, which was added later to the paper. So thanks a lot indeed for further discussion. Many thanks.
Very good. Thank you so much, Boris, as well, for the reaction. And we have a few more minutes for any questions in the room, in the audience. Anyone? Either one long question or a few very short questions.
Maybe I have one if...
Oh, there is a question at the back.
No. So, thanks, very interesting. I was just wondering whether you could use quantile local projections. I think it's a really recent like addition to these standard local projections, just to show the heterogeneity in effects,
Yeah, that's definitely a good suggestion. I mean, yes, I'm aware that there are some new papers on this, so definitely that's something that could be interesting to sort of see how it depends on essentially what is the level of the outcome variable at the moment. So at the moment, the only thing that we go in this direction is essentially do some state dependencies that I have not shown with regards to the different like initial level of the CO2 emissions. But the quantile regressions would definitely sort of help to show this in a more pronounced manner. So thanks a lot.
Thank you. And Jan, I think did you have a question?
I mean, if
there's anyone else still in the room, now is the time, very much.
Okay, I have one, but it's actually to Vladimir. Sorry for that.
I'm not the presenter, sorry.
It's okay.
No, okay, I know enough and very little about environmental economics, but the environmental Kuznets curve, I always thought about this being about domestic pollution, about you're poor, you industrialize, you produce a lot of pollution, at some point you get rich, you don't like that. But CO2 is not a local pollutant. CO2 is, at least maybe that's my physics knowledge is not good enough, but I think it's not a local pollutant, so therefore I would not expect a Kuznets curve like for other stuff, or what's...
Well, indeed I agree with you that CO2 globally is a public good or public bad, so that is undeniably. The point is that when you use this regression analysis, you basically assume that it's local. And this is what is assumed by the analysis. Otherwise, there has to be spatial controls in this case. But anyway, we have this theory regarding the environmental Kuznets curve with the tipping points, and we can basically hypothesize where the developed countries are, whether they pass this tipping point, and it's quite nice if they pass it, where the developing countries are, whether they're in between or somewhere else, or we cannot confirm any hypothesis. So it means that theoretical model doesn't work, or there may be some other underlying assumption in this case.
But essentially, so in our case, what we are looking at is specifically like the CO2 emissions intensity within a country, right? So essentially, an estimate, and there you actually do see this Kuznets curve, right? So from the control variables, you do see that essentially it is there.
Okay, well, thank you very much. Jan, I was looking forward to your question, but now we have 1 second, and
we discussed with the
exactly.
so that's fine.
Exactly. You can talk off the stage. Thank you so much to all of you, to the audience, and to all the speakers on the stage. So we have, I understand, made it all the way to nearly the end of the conference. I personally, I am very much taking a lot of interesting insights with me. I might need to reread some of the slides and presentations, but so hopefully they will be available, and I think some of them are already. So thank you once again, and I believe we have some final remarks still on the agenda. So I believe, yes, thank you. Very good.
Okay, so now I will summarize all 14 papers, or however many there were. I think you're looking forward to that. Yeah, no, thanks for sticking around. Everybody who's still here. It was very, very nice. As you all can imagine, a conference like this will never work without many helping hands. Those who are not here, Tatiana, I guess some of you had email exchanges with her, the press officers, conference department, Richard, and Richard actually fell ill 2 days ago, but still in the background he managed with phone and email, etc. And Hannah, I think she's probably waiting outside, so the nice lady who collected everybody. And of course the organizing committee from CEPS, it was Carol and Apostolos, I think both gone. But then from SUERF, Dragana and Ernest, and actually a big applause to two of you, because it was really a pleasure working with you. And of course to the the local team, the representative Rainer, Jan, Florian, to help with the paper selection, discussion, blah, 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 and everything. So thanks to all of you. And safe travel home.